Right behind you.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Okay, the Mendocino County Board of Retirement meeting for March 19th, 2025 is called to order at 8:31. First item is election of board secretary for 2025 and appointment to the audit committee.
Do we want to take a roll call?
We do need to take a roll call first. I think I missed it last time.
Excellent. Mr. Kelly?
Here.
Ms. Cavanis? Here. Mr. Cromer?
Here.
Mr. Shoemaker will be absent. Ms. Harris?
Aye. Oops, sorry.
Here. Mr. Swope?
Here.
Ms. Cubison?
Here.
And Mr. Land?
Here.
Thank you.
What about Mr. Haschak?
Oh, and Mr. Haschak.
Here.
Thank you.
Okay.
Okay, everyone's here.
So, like I was saying, the first item is the election of the board secretary for 2025 and appointment to the audit committee. As you know, we have a swap of Sarah Pierce for Ms. Cubison, Trustee Cubison. And I was wondering if we had any volunteers who would like to assume Sarah's place as secretary.
Don't look at me.
Our secretary does not really do anything, it's really just a figurehead. I suppose if both our chair and our vice chair were absent, the secretary would be the next choice to serve as the chair of a meeting if that occurred, but it's not occurred during my tenure here. But all the other official duties of the chair are handled by staff.
Is it a one year?
Yes.
It's through the end of the calendar year.
Alex, I'll do it if nobody else will.
Okay, we
You might be
have,
able to strong arm Charlie into it. I saw him waffling there.
No, Charlie would be good.
Yeah, you go too
As long as
far.
as long as there's no requirements, yeah, sure.
okay, so in that case, if we have nominations, I would like to nominate Trustee Kelly for the position of secretary. I believe we need a second,
Aye.
or is it just a
A second.
second? Would you like to call the roll?
Yes. Ms. Cavanis?
Aye.
Mr. Haschak?
Aye.
Mr. Cromer?
Aye.
Ms. Harris?
Aye.
Mr. Swope?
Aye.
Ms. Cubison?
Aye.
Mr. Land?
Aye.
Mr. Kelly?
Conflict of interest?
That's why I hesitated. I didn't want to call on you first. Okay.
Okay, so the next item here is the appointment to the audit committee. And the audit committee was also, Sarah was also a member of that. So I am hoping that somebody who is not currently on the audit committee would like to volunteer to serve on the audit committee.
If someone wants to know what the obligation is, I'm happy to talk about what happens with the audit committee and how often we are expected to meet, which is probably 3 times, but 2 to 3 times a year. The meetings are fairly short historically, about a half hour each, but the new meeting is being added because we're adding the agreed upon procedures review, and that's a new engagement where the auditor will provide findings on that process and tell us if we, where we can make improvements. So that's what one of the new meetings is for, and it might extend the length of the other meetings a little bit.
Are there any volunteers?
Can you tell us when the meetings are? Can you tell us when the meetings are?
The next meeting is on April 9th at 10 a.m. and after that, July 9th at 1 p.m.
And then the last meeting is early November?
It's probably mid-November.
Mid-November?
Yeah.
So we're looking at roughly March or April, and then July and November. July and November are pretty routine. The other one we haven't really had before, but we are using this one in April to review the RFP responses to make a recommendation to the Board of Retirement on engagement contract with the UAP auditor. So this April meeting is really just selection of an audit firm to bring to the board. The RFP closes on March 28th. Yes, Mr. Kelly?
Does the secretary need to attend
No.
these meetings?
No.
Unless you
Surprise.
get appointed to the committee.
If you would like to volunteer to serve on the audit committee,
Perhaps.
I believe I saw a volunteer in the form of Mr. Swope.
Yay.
Yay! All right, that would give us a full complement on the committee if that meets with the chair's approval.
it does. Yeah. If you didn't volunteer, I was going to have to appoint somebody. Which.
You were going to have to volunteer someone. That's the,
Yeah, yeah. Which I was not looking forward to. So I guess then I just declare you to be the new trustee. Leonard Swope will be serving on the audit committee.
Yay.
All right. That moves us to item 2, the consent agenda. All matters on the consent agenda are to be approved by one action without discussion unless a board member requests separate action on a specific item. Does any trustee wish to pull an item from the consent for discussion?
I'll move approval.
I believe we need to ask for public comments first. Not seeing any public comments, nothing online.
No, it doesn't appear. Well, let's take a look at our participants here. I think they're all our consultants.
Well, they are welcome to comment.
So there is no public comment.
Okay, the consent agenda is approved by unanimous consent. Item 3, historical benefit review project status report and project updates. Doris Rentschler, Executive Director.
Thank you, Chair Kelly. I'm happy to answer any questions. It does appear that the report may not have been posted to the website. It is available in the SharePoint, and we'll get the website updated. This report just gave the status of the current correction project with the most recent corrections that had been completed.
Do we have any board member discussion on this item? Do we have any public comment?
There is no public comment.
Okay, thank you very much. Item 4, investment matters. First up is an introduction from Callan, Greg DeForest, and Claire Tellen.
Thank you, and it's nice to see you all. I wish we could be there in person, but also want to keep my germs to myself, so apologies. So what are we doing today? Today we are filling in the last piece of the international structure that was adopted by the board at the end of last year. So I can't see the slides. Do we have the slides up?
We do not, but we can momentarily.
Wonderful, thank you.
It looks like Hannah has
Oh,
it.
Hannah's going to
Oh,
share.
Hannah's-
There we go, perfect.
Great,
Yeah.
Hannah can share.
great.
Perfect. So just the first slide here is to recap where we've been and where we're going, what we're doing today. So as a reminder, the new structure for the international equity portfolio that was agreed upon by the board is in the bottom right-hand corner here. And the structure that we currently have that we're moving away from is on the bottom left. So we're moving from a completely active implemented portfolio to one that has a core index manager that's been selected to be SSGA, which will represent 63% of the portfolio. And then we're taking our active or using our active risk budget with dedicated emerging markets managers and international small cap. So today we are interviewing managers for that last piece of the pie circled there for the second international small cap manager. So as a reminder, the last time we met, you interviewed emerging markets managers. You selected Artisan to complement existing manager 91, who's done a nice job for you. We think they'll be a good pair going forward. And today we're looking for an international small cap manager to complement T. Rowe Price. So T. Rowe Price has been in the portfolio for quite a while now and has done a nice job for us. This mandate will represent about 5% of the total international structure. And in dollar terms, that's a little less than $10 million. So we're looking at about $9.5 million to allocate to this new manager. In November, we met to review finalists from the search for this mandate, and we talked about 3 finalists. And the decision out of that meeting, after kind of running through the 3 finalist candidates, is to hear from all of them. So that's what we're here to do today. We're going to hear from each of the 3 finalists. That's AQR, Brandis, and Causeway. So on the next page, just a quick snapshot of those 3 managers. So AQR, Brandis, and Causeway, those are the 3 managers we're hearing from today. All of them we're looking at international small cap mandates. And importantly, because we're complementing T. Rowe Price, who had a bit of a growth orientation to that strategy, each of these 3 managers has a bit of a value orientation to it. So we think they're all good managers. All of them would be good choices within the total structure, and they all have a bit of a value orientation to them, albeit at somewhat, there's a bit of variation there. So we'll look at that in a minute as well. On this page, we have proposed vehicles, so all institutional quality vehicles. We have product and vehicle assets under management for each. Importantly, they're all of sufficient size to accept our $9 to $10 million mandate here. And then we have investment management fees for each of the 3 mandates. And you can see that those fees range from 75 basis points for Brandis to about 110 basis points for Causeway, AQR falling somewhere in the middle at about 95 basis points. So I wanted to point this out because it does feel like a bit of a range. And there's 2 things I wanted to put into context. So one, when we compare these fees to the fees that you currently pay your developed markets managers that will be moving away from in the new structure, they feel a little bit higher. But importantly, from our assessment, these are all reasonable fees for the asset category. So that's important to keep in mind. And then the other context I wanted to provide is actually on slide 18, or I think it's 17 for the bottom right page number, which is a slide that we looked at when we first evaluated these managers, which is a bit of a pro forma of fees for the total international structure. So in the top half of the page here, we have the current structure with the existing managers. In aggregate, you pay your active managers about 75 basis points in the international structure. The new structure with the candidate managers in the bottom half of the page, again, we're just filling in that last piece today. The bottom line shows us that because we're moving towards an index implementation of the core allocation, so 63% of the portfolio will be with an index manager, the fees for the total international structure are going to come down meaningfully. So I just wanted to put into context that while we're looking at a range of fees for the international small cap managers today, we do think that they're all reasonable for the asset category. And also in the context of the total portfolio, it's actually only a difference of about 2 basis points. So just wanted to put that into context before we dive into actually assessing each manager individually. Headed backwards in the presentation here. I won't spend too much time because we want to hear from the managers directly on who they are and what they do and what strategies they're proposing here today. But maybe just quickly, kind of some key differentiators from my perspective. I believe we're hearing from Brandis first, and then we'll hear from AQR and Causeway. So Brandis is a fundamental strategy. AQR and Causeway are quantitatively run strategies. So at a high level, Brandis, 100% employee-owned firm based in San Diego. They run mostly non-US and global strategies, and they're known for their value strategies. So again, we're looking at a value-oriented strategy here today. When we compare Brandis to the other two strategies, it is a kind of a deeper value strategy. So I think that's notable, and that comes through in the performance, particularly when we look at the performance versus the core peer group and benchmark, as well as versus AQR and Causeways. Brandis does, bottom-up fundamental research, and because they have that deeper value orientation, they're going to be the most levered to value cycles. And what that means for us when we look at performance and when we think about, what the experience would be if we allocate money with Brandis going forward, is their tracking error versus the core benchmark and peer group is likely going to be higher. That's what we see in their historical performance, and I think that's what we could expect on a go-forward basis. So there are periods where they're top quartile. There's certainly periods where they're bottom quartile performance. But over the long run, they've done well. Otherwise, they wouldn't be here today, right? So anyway, a couple things to think about as we evaluate the performance for Brandis and things to think about.
We have a question.
Their presentation.
Claire, we have a question.
Great.
The slide that you're at mentions the CEO is not from an investment background. What is that background?
Greg, do you know the answer to that? I do not. We can ask when they come in.
Our research team put that note in here, and sometimes we like to know if an investment professional is running a company or not, and it can be a different culture when they do and when they don't. But at the end of the day, you need someone who can operate a company, who can run a company, and to me, that's the more important topic. And so we'll clarify that in the coming minutes here.
Any other questions so far?
Actually, I do have a quick question, Claire. On slide 2, it showed the different ownership structure, proposed vehicle, an LP, a trust, and a mutual fund. And I just wondered if there were any significant differences or concerns or issues that the board should be aware of regarding those different structures.
So they're all institutional vehicles that we think will work in your portfolio, have sufficient liquidity, and so I don't think there's any key issues with any of them.
There's a little more contracting with the LP and the trust than the mutual fund. The mutual fund you could just go out and execute on your own, but there's a little bit of agreement review and contract look with the AQR and Brandis portfolios. We don't think that should be considered a hurdle for you, but that from Jeff might have to take a look at a couple documents here as opposed to just executing a mutual fund trade.
Okay, thank you. I appreciate that.
Yeah.
So based off a quick Google search and the Brandis website, Mr. Murray joined the firm in 2002, and he's been responsible for client services and business development. So he's been around a long time.
Thank you for that.
Mm-hmm. All right. So just quickly, the other two firms that you'll hear from, again, AQR and Causeway, both run quantitative strategies, so model-driven strategies, different than from the way that Brandis approaches construction of the portfolio. AQR stands for Applied Quantitative Research. They are a largely independently owned firm, headquartered in Greenwich, Connecticut, with 7 offices globally, and they run quant strategies. So the majority of the strategies they run, they're really focused on alts and equities. This portfolio is constructed using a quantitative model. You'll hear them talk about value and momentum. It's a combination of top-down and bottom-up models to generate the portfolio, and when you put it all together, it's a much higher name count than Brandis. So that's expected from a quantitative strategy versus a fundamental strategy. The AQR strategy typically owns between 400 and 800 names. So compare that to Brandis, which is typically 60 to 80, a much more concentrated portfolio. One thing you can expect to hear from them is, as they talk about their model, they'll probably talk about it as being a dynamic model. So they use machine learning to look back in time and make adjustments to the model, but that's something that I'll be listening for, kind of in their words, how they describe their model and how the portfolio gets constructed. Compared to Causeway, which is the other quantitative strategy that we're looking at today, you know, the AQR portfolio, because of that dynamic component, tends to be a bit more core to core value. So again, Brandis is going to be the deepest value. AQR, I would say, is more core value, and then Causeway ends up being somewhere in between. And then lastly, Causeway. Causeway, again, quantitative process, a very systematic process. Another 100% employee-owned firm. They are based in LA. And one differentiator for their product is that they do run a quantitative strategy, but it has a bit of a fundamental element to it as well. So that's something that we can expect to hear from them on. It's about 90% bottom-up quantitative, with then kind of a top-down 10% component to the portfolio construction, really looking at macro and country characteristics of the portfolio as they, you know, assemble the strategy in total. So they do leverage their
Claire, we
fundamental team.
have a question. Trustee Swope.
How does one estimate capacity?
Well, so different firms do it differently, but a lot of firms will look at the weighted average trading volume of the securities they buy, and then see, you know, if they did trade, how much of a percent of a daily trade their trade would represent. And then that would, you know, get a feel for, can we execute our trade and not move the market adversely to us? So there are a few ways to do it. So trading volume, another way you could do it is, you know, what's the percent float that we hold? You know, if we bought a security, would we own 1% or 4% of the float? So there are different metrics one can use, and it'll change a little bit based on the asset class. You know, U.S. large cap stocks are very different from international small cap stocks, for example.
Is that?
Thank you.
Thank you.
Thank you.
All right, before we turn it over to the managers, I'll hit just a couple more slides. The next slide looks at a style map. So this is something that we've looked at before, but I think is a nice visualization of T. Rowe Price and the managers that we're looking at to complement T. Rowe in this pairing. So T. Rowe is, again, your existing manager, kind of in the gold color there on the right side of this chart. And as you can see, T. Rowe has a pretty consistent growth orientation to the strategy. The three managers we'll hear from today, AQR, Brandis, and Causeway, on the left side of this chart in blue, orange, and gray. And as you can see, each have a value orientation to their strategy. And that's intentional because we do think that they'd be good complements to the T. Rowe strategy in this pairing. As I mentioned, Brandis is going to be the deepest value, and you can see that pretty consistently the furthest left on this chart. AQR and Causeway, a little bit more relative value, so a little bit more kind of core value. Given kind of that dynamic component to AQR's portfolio, I would expect them to be kind of the most core value, Brandis the deepest value, and Causeway sort of somewhere in between. But I do think this provides a nice kind of visual of how those managers could complement each other in this strategy. And then lastly, just a quick note on performance on pages 7 and 8. So on page 7, we have performance for each of the three managers that we'll hear from today compared to T. Rowe Price. We also have the peer group, so a peer group of other international small cap managers just below the T. Rowe Price performance. And then benchmarks. So the MSCI ACWI XUS Small is the benchmark that we'll use for that small cap component of the portfolio, looking at T. Rowe and this other manager together. We also have the small value for reference. Big things to note for performance for each of these three managers is all of them have done really well. So the small numbers in parentheses next to each performance number represent the peer group ranking. And you can see that across all of these time periods, each of these managers have landed in the top quartile of the peer group. Now, one, I think we would have been happy had we had any of these managers in the portfolio. Two, keep in mind that this is a core oriented peer group and a core benchmark, right? So in the last three and a half calendar years, having a value orientation to your style within international small cap has been a tailwind. So I think it's helpful to look at page 8, which has calendar year performance. And you can see that in the last, 2021, 22, 23, 24, all of these managers have really done well versus this peer group and have had a bit of a tailwind from that value orientation being in favor. If you look at 2020, 2019, 2018, 2017, we see a bit more volatility within the peer group rankings. So keep that in mind when we think about performance patterns and what we can expect in the experience if we were to invest with each of these managers. Brandis, because it is the deepest value strategy, has seen some periods where it's been bottom quartile. So 2017, 2019 in particular, they were bottom of the heap, but then in more recent time periods have really been at the top of that peer group. So again, just something to keep in mind when we think about the performance pattern to get to those 10-year returns that we saw on the previous page. Again, putting it all together, all three of these managers have done really well. I'll pause there. We can certainly come back to this and dig in more after we hear from each of the three managers. But if there's any questions, we're glad to take them, or otherwise we'll turn it to Robert to introduce the managers.
Okay, we ready for Brandis? Yep. All right.
Of humans.
Good morning.
Good morning.
Good morning.
How are you?
Take seats here at the end.
Morning, everybody. Good morning. So I brought 6 copies for your instruction.
Yeah, we have a few hard copies. I know we have a mix of folks who like hard copies and electronic, so
Anybody want a hard version?
copies?
There you go.
This is Tim and Mark.
I'm Tim.
And of course, they'll introduce themselves here.
You're very welcome.
Thanks for being here, guys. Everybody else?
Okay, our pleasure. We had a lovely drive up from San Francisco last night, but it was dark, so we're looking forward to the drive back to actually see
share,
that.
or do you want me to? I have it
Could you share?
ready.
Yeah,
so.
go ahead. Share, yeah.
Yeah, I'm sharing. I know this. Okay.
You might have to move that box.
Change my view.
This is a copy to refer to.
Just move it.
Here we are. And then let's see.
How many folks do we have online, Robert?
Callan's online,
Okay, great.
and everybody else is here.
Great, excellent. Well, good morning, folks at Callan. Thank you very much for joining as well.
Can you move that and maximize it? Move that box. I think the max is underneath it.
This is maximize.
Can you move that?
This?
Yeah, sometimes underneath there.
No, it's not.
That is full screen.
That's
Okay.
full screen, so we'll just go with that. Okay.
Thank
Ready
you.
to go?
Yeah, go for it.
Great, thank you. Well, thanks again. As Robert mentioned, my name is Tim Newbern. I am responsible for business development and client service for Brandis's institutional clients, both in Canada and the Midwest and Western states. I've been with the firm for 23 years, and very pleased to have Mark Costa with me. Mark comes from our San Diego office. He is he's a 24-year veteran of the firm and limited partner, member of our Small Cap Investment Committee, which is the team entrusted with managing our international small cap strategy, and also has research responsibilities in the industrials team. So what's a consistent theme at Brandis is we operate in teams, and that members of our portfolio management groups are also themselves involved in research. So they're not too far away from the process at any given point in time. And Mark will go into more details on that as he talks about our process. So we really appreciate the opportunity to be here. We want to keep this as interactive as possible. So as questions arise, please ask away. We're happy to cover those in the context of the meeting or afterwards, whatever works best for you. Let's just jump to slide 3, which is the agenda page. I'll just briefly review what we'd like to cover today. We recognize that, in your relationship with Callan, there's been considerable work done on analyzing various managers like ourselves. And certainly our goal today is not to repeat the good work that Callan has done, but really to highlight some of the key traits that we feel are worthy of considering us as a strong complementary piece within your existing plan. And so I'm going to make some very brief comments about our firm, and if there are any questions on the firm that you want to ask, please do. But I'd really like to spend some time focusing and highlighting on how our strategy does fit within a diversified style plan. And we think this is very important because, as you may have grown to understand yourselves, styles do actually cycle over time. And we think it's very important to demonstrate how we fit with other complementary pieces so that you as clients are best served over the long term. I'll then turn the floor over to Mark, and he'll delve into some details of our team, our process, and obviously, importantly, the strategy itself. So on page 4, we just outlined some of the details of our firm, and we're very proud that this month we're actually marking our 51st year of being in business. And it's very important, I think, that I stress to you that throughout our 51-year history, we have been committed solely to global value investing. So we apply the same discipline and process across all strategies within our firm, whether they be small or large cap equity, equity or fixed income. We operate under the same value principles. And all that we do, from our 100% employee-owned structure to having a team-focused research and investment process, is really geared to maintaining this long-term focus on price disciplined or value investing. We recognize and appreciate the fact that through our 51 years we've accumulated considerable experience, and we think that experience is a great teacher. So the fact that we have been through multiple investment cycles, political commodity cycles, is something that we do treasure. And although we're very much committed to our value strategy, which we'll talk about, I don't want to give you the impression that we're dogmatic. We are willing to learn from our experience. We are willing to look at ways in which we can improve and create even more value within our client relationships over time. A few key beliefs that we have as a firm are outlined on page 5. First and foremost is this belief that the price paid for an investment is a critical factor in determining what the long-term success or failure of that investment will be. So we do spend an awful lot of time in really understanding the value of a business and building our portfolio in accordance with those principles. So our approach is really based on identifying significant discrepancies between the fair or intrinsic value of a business and its current share price. And Mark will talk a little bit about this in the process section, but this whole concept and importance of the margin of safety, this discrepancy between price and value, is really a critical cornerstone that we believe in within our firm. We're comfortable with being contrarian in terms of our viewpoint, and we are, because we're confident in our abilities as an organization to research companies, to understand businesses in a thorough basis. And we also recognize that if your goal is to outperform anyone in life, in whatever you do, you have to be different. You have to come to the table with some different viewpoints and thoughts than everyone else. Otherwise, you're simply going to mimic everyone else in whatever you're undertaking. And what really draws all these beliefs together for us is the fact that we do have a long-term mindset in everything we do, from the way in which we operate our business to the way we manage our client portfolios. And we do have that independent ownership structure, which really enables us to ensure that we're always working in our clients' best interests and to their benefit, not that of an outside owner. So we think that's a very important consideration as well. Many of our discussions with consultants and prospective clients really relates to this whole idea of how we fit within the context of a diversified portfolio. And page 6 really illustrates how our international small cap portfolio reflects pure value characteristics and positioning. And we think this is of critical importance, obviously, if we're seeking to complement other offsetting strategies. But in addition to our style consistency, if we review our performance, our investment results through periods where value has both led and trailed other investment strategies, a pattern tends to emerge which reflects how closely aligned we truly are to the value style. And on page 7, we illustrate our performance in dark green, which is net of fees, I might add, throughout this whole deck, versus our value peer group during periods of both strong and weak value and growth performance. On the left side of this page, you can see that when value does well, our strategy tends to outperform not only the broad index, but also our value peer group. And on the right-hand side of this page, you'll see two sets of bars that really are this data broken down in periods of up and down markets. Conversely, in the second set of bars on the left-hand side, you'll see that when the growth style tends to lead, our results will tend to lag a little bit. And clients that have known us for a number of years, have worked with us through multiple cycles, really understand and almost grow to expect this from us. Because of our strong commitment to our value style, when it tends to be out of favor, we may pale a little bit in terms of our results relative to other strategies. But we feel that that's okay within the context of a complementary strategy and a well-diversified portfolio. Also, in the middle of page 7, you'll see that in down markets, we've shown the ability to add alpha relative to the benchmark as well. And that, we feel, is a testament to, once again, our experience of going through multiple cycles, our ability to thoroughly research and understand not only the opportunities, but the risks, particularly as they pertain to balance sheet risks and other items with respect to the companies that we are researching. So given how we tend to be levered to the value style, the question then becomes, how can we hold up as a complement to other styles and strategies? And on page 8, we understand that an objective of your search is to find an effective complement to an existing position in the T. Rowe Price International Small Cap strategy. And I thought we'd take the liberty to just apply this same style-based performance to creating kind of a side-by-side comparison of both our strategy in green and the T. Rowe Price strategy in blue. And as you can see from page 8, both strategies complement each other very, very well. As I mentioned, we tend to be levered to value, so when value works well, when value does well, we do better. But T. Rowe Price also does extremely well when the growth style is in favor, which is a good thing. So both strategies seem to complement each other well. And slide 9 highlights really the potential value added, which is created by combining Brandis and T. Rowe Price in a very simple 50-50 blend. So nothing too scientific about that. But regardless of whether value or growth styles outperform at any given point in time, there's evidence in the top half of this page that a combination of these two elements does add value over longer periods of time to the plan. This is based obviously on back-tested and not real data because we haven't been combined with T. Rowe Price in this strategy. So I just want to make that clear, but nonetheless. The bottom half of this page, we basically have shown how the performance would look if these were combined looking backward from the end of last year. So you can see once again that it does illustrate that the two pieces seem to fit quite well together. Any questions with that? I know there's a lot of data and slides that I threw at you there in a short period of time. So great. Before I turn it over to Mark to talk a little more about how we make the sausage and build the portfolios, I'd just like to introduce you very briefly to our investment process. And I'm just going to focus on really the 3 steps and the key players within each step. So on page 10, we illustrate the 3 parts to our process, the first being analysis. And this is really the step that is the engine within our entire process. And we truly believe that our research engine, our research team, is a strength of our firm and an edge that we clearly bring to the marketplace relative to many of our competitors. So analysis for us is the fundamental research that's undertaken on individual businesses. And we have a structure comprised of 25 research analysts that are supported by 16 associates and are grouped by global sector. So I mentioned earlier that Mark is a member of the industrials team. We believe very strongly in grouping our research by sector, not because we invest by sector, and I do want to make that really clear. We're not looking to use sectors as a reason to own certain companies. We want to ensure, though, that in-house we have resident experts that truly understand the deep and interconnected dynamics between businesses within their sector of concentration on a global basis. So we feel that having this in-house group of research experts is of great value to our firm and ultimately to our clients. So our analysts and their associates spend their time screening for opportunities. They undertake research projects on individual companies, which typically take between 2 and 3 weeks. Out of those projects, they will produce research reports that are in the neighborhood of 30 pages in length. And ultimately, the goal of this entire process is to fully understand each company and what the key drivers of value are within each business, and to identify a specific fair or intrinsic value for each business that has been researched. So intrinsic value can be defined as the value that a rational businessman or woman would place on a company if they were looking to buy that company in its entirety. So really taking a fundamental view of the business and what it's worth. The 2 other steps of the process, value and construction, reside in the hands of our investment committees. And Mark will talk about his team that he works with and the work that they do. But each of our committees meets once a week at least for between 3 and 5 hours, depending on the amount of work to be undertaken. And they will initially, in the first part of the meeting, spend time on valuation, where they will have research presented to them by analysts. And then they will, as a team, further discuss and debate that research and arrive at their own estimate, their final estimate of intrinsic value for every company that they have heard about. The second part of each meeting is the portfolio construction, and that's really, once again, something that's done completely in the purview of the investment committee, where they look at new ideas that are presented as well as existing ideas on their monitoring list, other companies that have been researched over time, and seek to build the most effective value portfolio that they can based on their opportunity set. So with that in mind, if there are no questions to this point, I will pass it over to Mark, and he can go into to more detail on team and process. Yes, sir.
Does your portfolio turnover change dramatically over time, or will that be covered?
Yeah, Mark can touch on that when he talks about maybe some of the companies and activity that we've had recently, but certainly our longer term reasonable average of turnover is roughly 30% per year. So it's on, I think, the lower end of many investment strategies, but certainly we don't shy away from turning over names as opportunities present themselves. So. Great. Over to you, Mark.
Okay. Well, great meeting, everybody. Thanks for having us. If you just turn to slide 12, that's where my portion of the presentation will begin. And I just want to make this conversational. If you guys have any questions for me during the presentation, happy to stop and answer those for you. I'm going to spend a little time on this slide, so please bear with me, but it is an important slide. It's what is our edge? How do we add value for clients? And it's important for us to be able to understand what our edge is and help you understand why it's repeatable. And as value investors, we strongly believe, and history shows, that value investing works, that knowing the businesses that you are owning and at the price you're paying, that allows you to build wealth for clients, but also allows you to preserve capital. So the two tenets of value investing, in our view, is preserving capital and building wealth. But what makes it extra exciting about this asset class that we're digging into is how inefficient it is. Our ability to exploit those price dislocations should be greater the fewer people that are looking at analyzing those businesses. And so this is an asset class that it's exciting to build portfolios in. There's 7,000 companies that we get to pick from. We only own 60 to 75 names, so we can be very selective and concentrate your capital to our best ideas. And while there's 7,000 companies to look at, most Wall Street analysts are looking at the large cap names. So the 1,000 companies that everybody's writing research reports on, that everyone understands really well, the companies you hear on CNBC, there's a lot of eyeballs looking at those names. There are very few eyeballs looking at this asset class. And so what is exciting is that we have a research group that is purpose-built to exploit those opportunities. So we have, as we mentioned, 25 research analysts who are sector experts looking around the globe across all market caps, which is great for us as a portfolio management team. There's 4 of us, and I'll talk about that team here in a bit. But what's great is that research that we're consuming is done by analysts that have been covering their sector for 20 years, and they're looking across the entire market cap spectrum. So they understand the entire value chain of that industry, and they're also looking at it globally. So they're not just US analysts or Canadian analysts or European analysts, but they're looking at how does the industry fit globally and how do those companies fit within that industry. And that allows us to really exploit those dislocations in price that we're seeing. And then obviously as value investors, we're thinking very long term. We don't think of owning a business as a piece of paper. So, a lot of investors will just buy the stock, hope it goes up in 3 months and sell it. To us, that's not what we do. We are owning a business. We think like business owners, and we're thinking very long term. So 3 to 5 years at a minimum is how we're thinking about the businesses that we're pricing. And that allows us to buy the COVID cyclicals, like an aerospace name when there's COVID lockdowns. We're not thinking about, is the recovery going to be, or is the reopening story going to be in a month or 6 months or a year? We're indifferent. We're saying, what does the world look like 5 years from now? And can I underwrite this valuation very conservatively and exploit this overreaction of the marketplace? And so you'll see that we have a big overallocation to aerospace and defense, in part because of the opportunities of COVID. We also are willing to analyze complex issues. So outside of the US, a lot of international small cap names are organized they're still owned by the founding family, who organize those companies, and holding structures can be very complex. So if you're a small team in a small cap, running a small cap mandate, you may not have the resources to roll up your sleeve and price those businesses. We do, and we're willing to do it, and we have a long history of doing it. And an example would be a company called First Pacific that we own. It's a company that's listed in Hong Kong. It's sold off with all the Chinese fears. Hong Kong tends to sell off with China. This is a company that has very little to no exposure in China. It's a family-owned business. They've got 4 primary assets. They have a 70% market share in instant noodles in Indonesia. So the dominant player in Indonesian instant noodles. They are the #2 wireless telco operator in Indonesia, and they own utility assets in the Philippines. So this asset is priced at a 50% discount to the cumulative value of those publicly traded companies that you can go look. You can price them, add them up, and you can buy First Pacific at a 50% discount. And those assets are also priced at a discount. We have a utilities analyst that can price MLDT, we have a telecom analyst that will price PLDT, and then we have a consumer products analyst that will price the Indo Foods asset. Again, this pays like a 7% dividend yield, very cheap. So we're willing to do the work, roll up our sleeves, and have the long experience doing that. And then we also, I told you that we think like business owners, but we also want to act like business owners. And so the engagement is a point I just wanted to bring up. We engage management teams. We talk to the companies before we buy them. And then we also engage when we feel like there's some value add. Now, we're not going to tell companies how to run their business. That's not what we do. But if we think they can pay a bigger dividend, or maybe they can buy back shares, or if we feel like their acquisition strategy is a little too aggressive, that's where we can sort of fulfill our role as a business owner. And we have a history of doing that. There's a company in the portfolio, the largest holding is called Embraer. It's a Brazilian aerospace company that we've owned for many years, off and on. And we recently were able to get 2 new board members put on the board. It's the first time they've had an English-speaking board member. The former CEO of the Boeing commercial division, and a leading leasing company executive from GE Capital. So those are the kind of things we can do to enhance the portfolio. And then I think the most underappreciated element of what we do is what we don't own. So you can obviously look at our portfolio and say, okay, they made these investments, they worked or didn't work, but what you don't see is what we didn't buy, and our willingness to build portfolios that are high conviction. We can avoid overpriced areas, we can avoid risk, and we're willing to own 0 to a sector. So when oil was over 100 during the peak of the China boom, we owned no oil, we owned very little commodities. But when that cycle turns, then we're willing to roll up our sleeves and allocate capital to that. So, yes?
You bring up Hong Kong versus China.
Yeah.
And of course, President Xi demanding more and more compliance. Really, is there a different environment in Hong Kong for a business operating versus in China? I'm sort of curious.
Yeah, so Hong Kong was a former British colony, as everyone knows, and they had strong property rights. So a lot of companies in Asia would list their companies in Hong Kong because there's better corporate governance and there's a structure there. So there's a historical legacy for why companies list in Hong Kong. Now, what we care about is where are your operating assets? And so when China got really scary, we don't have the crystal ball to say this is how it's going to work out. Property rights are going to be respected, capital markets will be respected. So it's really difficult to go into China and then have a very strong conviction in terms of the businesses that we're owning. We're also concerned about the level of debts that have been built up in the country. Their housing market is at very extreme levels compared to what even the U.S. was at, and then their banking system has a lot of leverage because not only the housing development, but of the fixed assets that they've invested. There's some evidence that maybe they've overinvested. So we're a little skeptical about just the cycle there, so we've been patient. But when China gets scary and the market sells off everything, you want to say, where are their babies being thrown out with the bathwater? And Hong Kong was a really great example of that, because I could go in, buy a Hong Kong asset whose operating assets are not exposed to these issues in China, but are priced at a discount because investors are saying, I don't want exposure to China. And that's kind of the nuance I was trying to tease out. And so First Pacific was an example where we could back up the truck and buy that asset take the risk. I mean, I guess take advantage of the risk without taking the risk. And there's several examples of that. Now, there are some companies listed in Hong Kong that do have operating assets in China, and so that would be a different story.
You mentioned 3 to 5 year thinking.
Yeah.
And yet also I'm trying to sort of square it with 30% per year turnover.
Yeah.
So
for our strategy, it's about 25%, 25 to 30 is the typical, and that kind of fits in our 3 to 5 year mindset, right? So the math actually kind of works out. In periods of volatility, though, we're willing to rotate the portfolio. So during COVID, we had a very defensive posture because markets were expensive, interest rates are low, management teams are borrowing tons of money, and so we were defensively positioned. We rotated that capital into risk when we were getting paid for it during the COVID lockdowns. So the turnover went higher than average. I think we had 25 new names in the first 6 months of the year. So it's going to ebb and flow depending on the opportunity set. Last year, we turned over 35% of the portfolio. So a lot of the names that we were buying during COVID, we were selling and then rotating into like countries like Mexico, which is an area where investors are getting very concerned. And so we're finding some great ideas in Mexico and other parts of Europe too. Yeah. So if there's any more questions, if not, I can go to the next page. I think this is an exciting page. I love talking about this because when people think about small cap, they think about risk, right? Of course, it's very risky businesses. They're not as large as the Microsofts of the world. And that's particularly true in the US. And then when you think about outside the US, people think, oh, it's even riskier. But in reality, that's not necessarily the case. There's 7,000 companies to pick from, and in those 7,000, there are risky names, companies that may not have strong market positions, or maybe, they have a scale disadvantage. But there are a lot of names that are actually like large caps. There are primary businesses that are dominant in their country in important industries, and the reason that exists is because they're operating in smaller populations. So we own the largest wireless telecom operator in Hungary. It has a 50% market share in wireless telco. It also has landline and data, and they can bundle that. It's the only company in Hungary that can bundle that. And it's only a small cap because there's 4 to 5 million people. We own the largest cider company in Ireland, 10 million population, 70% market share, easy company to analyze, cash flow generative. These are not risky businesses. And so when you look at our portfolio, 73% of the companies have been around for more than 3 decades. The average company age is almost 70 years. 90% of the companies are generating positive free cash flow. This is not a risky portfolio, but the market perceives it to be risky, and so you get that risk premium that gives you that nice absolute return that you're looking for over a full market cycle. And so that's exciting for us because we're not going to be investing in small caps that are in the entrepreneurial phase of their life cycle, where you have to predict who the winners and losers are going to be in a social media environment, the technology or biotech. That's not what we do. Our job is to price businesses that we can understand, that have been operating for a long period of time in industries that are mature, and then exploit the opportunities when they arise and they get underpriced. And so the asset class fits our edge well. We love it because it's inefficient, and in the end, it's less risky, and so we can preserve capital, which I mentioned is one of the top tenets of value investing.
I have a question.
Yes.
When you say you're owning these companies, then what percent of the companies do you own? There's only 60 of them, right? Yeah.
So we are willing to own, 10 to 20% is kind of the max that we want, and we don't want the entire portfolio to be in that range. So typically 5 to 10% would be where the typical company might be. So hopefully that answers your question.
That's across multiple strategies.
Yeah,
in some cases.
Yeah, and then we're aggregating that as a firm, so that wouldn't just be this. Yeah.
I noticed on both in your page 6 of your presentation and also in Callan's presentation that your holdings lean towards the micro side. It shows up on the graphs.
Yeah.
Both of them. Is that a deliberate part of your strategy, or is that a consequence of how
Yeah.
things have just worked out?
It's a consequence of how things have worked out. So we want to go where the value is, and sometimes the value will be in a large cap. One of the great things about this strategy is that we are leveraging an all cap research group. So a lot of times during a dislocation like COVID or the war in Ukraine, you'll see large caps fall into small cap territory. So we own Rolls-Royce, which today is an $80 billion market cap. But when we bought it, it was a $6 billion market cap. But then we'll also buy First Pacific, which is $1 billion. So historically, we've always been smaller than the benchmark. I think smaller companies are probably more likely to be overlooked. Again, the more inefficient the asset class, the more opportunities you should be able to find. And so I think that's why we've been smaller than our peers and smaller than the benchmark. But we are going to go where the value is. And if we do see a $4 billion, a $5 billion, $6 billion company, we're willing and happy to buy it if it can compete with the other names that we're looking at.
Great questions.
Yeah. Okay, so maybe we can move on to the portfolio management team. And this is important because these are the individuals that are making the decisions of what goes into the portfolio. One thing I would highlight is that it's an experienced team, which means that the track record's relevant. So Louise and Yingbin have been on the team for 20 years. And I've been on for almost 15. Brian is the youngest member who joined 6 years ago. He's been with the firm for 15 years, so he's not a rookie by any means. He's been covering financials for Brandis prior to joining the small cap team and continues to maintain that coverage. So that's the first thing. The second thing is that we've been working together for a long time. What I love about this team is that we want to learn and get better. And so we do lessons learned meeting every year. We've been doing that since the great financial crisis in 2009. So this year will be our 15th year of lessons learned. And we go back and look at the idiotic stuff we've done in the past and like, what can we learn from that? Why did we get that wrong? And so a lot of value investors think it's the behavioral flaws of the marketplace that allows us to exploit opportunities, and that's true. But value investors also have behavioral flaws, and it's important for us to control for them. And we're very aware of that, and it's been fun to be part of this group. The other way I would say we can add value is that we bring diverse perspectives together. So we're pricing businesses, and it's important when you price a business not to have blind spots. So a single portfolio manager, if I was the sole portfolio manager, I certainly would have blind spots compared to working with this group. So, we talked about China. Yingbin's from China. She comes from a rural village in China, was identified as a gifted student, went to a prestigious university in Shanghai, came and worked in the technology industry, decided to pivot to finance, got her master's in finance, and so she prices technology companies for the firm. And one of the, I think, Achilles heels of value investors is that you can miss those secular structural changes an industry might be going through because of a technology disruption. It's great to have Yingbin on the team that we could talk about those structural risks that might be the next falling knife, and we can avoid maybe buying a cheap for a reason name. Luis is from Brazil. He has been with the firm for 23 years. He's a committed value investor. Prior to joining Brandis, he was in investment banking. And as you know, when we're buying companies and as value investors, a lot of times we're buying businesses that might be going through some structural issues. And Warren Buffett says that if you're at the poker table and you don't know who the patsy is, you're the patsy. And it's great having someone from the investment banking side that can tell us how we can get screwed over. Because there are very complicated situations where private equity or investment banks can come in and really destroy capital. And so he's on our corporate governance committee, and he helps the firm think about these issues. But again, it's great having him on our team so that we can avoid making those dumb mistakes. He also, from Brazil, has a long history of thinking about inflation, which from someone in America, like we haven't had to think about that since the 70s. And there are very few investment professionals today that actually invested through a period like that. And so it's great to leverage that expertise that Louise brings. And then Brian, he's a philosophy major, he's a deep thinker, super committed to value. And he also, covers financials. We try to not focus too much on the macro because, that's not an edge of anyone to predict macro statistics. But it is important to think about how the macro might affect an individual business. And as someone who covers banks, Brian brings that macro perspective that we can leverage as well. So, yes.
How do you handle different flavors of accounting when you are making your investment decisions?
Yeah. So we're always going to think about accounting and how that can be distorted and what adjustments we need to make to bring accounting to reality. And cash flow is really what you're paying for when you buy a business. We also like to triangulate our cash flow analysis with asset and balance sheet analysis. And so thinking about how the accounting might treat real estate, for example. Is it historical cost? Is it inflation adjusted? Those are the issues that we're going to think about. And we have a long history. We've been managing international since the founding of the firm, and we're very familiar with the different accounting standards globally. And I think it gives us an edge. That complexity gives us an edge because it makes it a little bit more difficult to understand, and maybe someone will miss something. So, yeah. So it's core to what we do. Yes.
You mentioned the magic word technology, and
Yeah.
I wanted to know how is AI intruding itself into your business, or how are you folks using AI at this point?
Yeah, so we've managed some tools that we're looking at. So we haven't rolled out anything sophisticated and robust that we're leveraging, but we're certainly aware of AI, and we are looking at some different licenses to make our research more productive. And in terms of like how it impacts our investing, it's not our edge to go and find the next AI company, but you can buy companies that maybe makes the picks and shovels that go into AI, or maybe the areas of the world that would benefit from it. My biggest thing is how could it disrupt businesses that exist today, and how do I avoid buying something that will get disrupted by the technology?
Yeah, my question was not which company to buy,
I see.
but how are you using it,
Okay.
or are you using AI?
Yeah,
in
so I
your
think
research?
I think individually we are dabbling with it, and then as a firm we are checking out a couple different licenses to see how we can make our research more productive. Yes.
Safe to say that we won't be using AI to make decisions, but certainly potentially, I guess, to support research efforts and data gathering.
Yeah, so an example would be, there's 100-page research reports that are put out by Wall Street industry pieces, and we could go through and go each page looking for the market share charts, or you could plug in an AI tool and have it pump it out from that report. That would be, a lot of leverage from us, and the more ideas we look at, the more opportunities we can identify. So that's kind of how I would imagine us using it.
I have a question in terms of just research broadly. I mean, do you use external, research? I mean, do you pay for external research? You've got on slide 15, the 25 analysts here with extensive experience. So I'm wondering about, the level of your own research versus external research, and sort of, is there a need to, what's the need to balance those two?
Okay, so because we're part of a 30 billion asset organization, we do have access to a lot of great research that Wall Street's producing, but you got to know how to use that research. We're not looking at their buy and sell recommendations, because typically Wall Street will just follow the short-term trends. In fact, when they put a sell recommendation out, we might actually be buying it. So we don't want to use the research in the wrong way, but we do have access to a lot of the data that they can produce. And if I want to get 50 years of commercial aircraft volumes, I could do it myself, or I could just go ask Goldman to provide that for me. And so as an analyst, I like to leverage their data, and then I'll read some deeper pieces that they might publish on an industry to help understand how the companies fit within that industry. Because I've been covering aerospace and defense for 20 years, I'm using that resource less now than I did when I started covering aerospace. But a new analyst would definitely be beneficial to read some of those deeper pieces. So I think if you're looking at a company you've never looked at before, Wall Street research can be helpful to get up to speed on it. But again, you want to read the company reports, you want to talk to the management team, you want to look at independent analysis. And a lot of times we're doing our primary work too, because Wall Street doesn't look at it the way we want to look at it. So we cover Embraer. Embraer is largely regional jets and business jets. So I had to create my own data sets going back to the beginning of the industry in 1995. And so sometimes we'll do primary research, sometimes we'll leverage it, but ultimately we're analyzing all those data sets and then coming to an independent conclusion.
Thank you.
Okay, so this is a perfect segue into this slide. Just wanted to point out that it's not only the number of analysts that we have that are sector specialists, but just the experience that they're bringing to the table. We're not consuming research that's done by largely a group of 5-year junior analysts. We're consuming research that is being done by specialists that have been around for a very long time that understand their industries deeply. And so that's a great resource for us. And again, having that all cap coverage allows our analysts to think a bit more cohesively about how the small cap company fits within the larger industry structure, which is important to avoid risk.
I think just to add to that, we also don't look at analyst roles as just a stepping stone to portfolio management. We do have members of our research team that are career analysts, and they're quite happy to remain as researchers. So in fact, we named a new partner about a year ago, just over a year ago, who has been a research analyst for 22 years. So we respect the work that's being done, and the fact that there are people that are quite happy in that role and don't need to be on an investment committee. So.
And every investment committee is an analyst, so we wear a couple hats. It keeps us nice and sharp on our analytical skills while we're thinking about capital allocation as well. So this list is filled with partners are presenting research, and some of those partners, as Tim mentioned, are not on the PM teams, and many of them are. So it's a very flat organization. We all work in San Diego except for one or two, all on the same floor. And what's great is if I have a question on a company I'm looking at and I need some expertise, I can walk down the hall and speak to, to an analyst that might have that relevant expertise I'm looking for. So there's a lot of, and it's a very strong culture, committed value investors, so this is, I think, a differentiating part of our process. And then this next slide is the meat and potatoes of what we do. So, getting back to what we're doing is we're trying to price businesses. So that intrinsic value estimate is what we think is a more stable estimate over time. So we don't think that businesses' values go up 30 to 50% in any given year. We think the market gets scared, or they get greedy, or they get, there's just a lot of volatility on a day-to-day basis in the markets. We think business value is fundamentally more stable. And so our job is to figure out what is that stable value. And there's a gray area, so we have it as a band because it's impossible to try to get to the exact point of what something's worth. There's a neighborhood, and we're trying to find out what that neighborhood is. Some companies are just inherently more uncertain, so that could be a very wide band, and maybe those are in a too hard pile. So if Buffett can have a too hard pile, we can too. But for the businesses that we can price, that's kind of that stable value. And this is what we're going to be doing at the first part of our meeting, is pricing businesses. And there's a couple of benefits to clients. One is that on the upper left part of the chart, you can see where the price is above intrinsic value. We're going to be avoiding that. We don't add any value by buying companies that are overpriced for clients. That's a way we can add value. When that price dislocates and starts to go below fundamental business value, either because of an economic recession or a macro dislocation or a political cycle, then we can go in and say, we're buying this at a discount. That protects capital, and we can get that excess return that you're looking for. And that's what we call the margin of safety. And the deeper the margin of safety, the more upside there are for clients, and more of a cushion in case something goes wrong. And then our sell discipline is when it gets back to our estimate of intrinsic value, that will be a trigger for us to sell and rotate that capital to other ideas that are trading at that margin of safety, which is how we reload the portfolio with our absolute return. Yes.
I assume that your intrinsic value estimate is somewhat flexible.
Yeah.
Which would lead, do you go into a position where they target sell price based on that your value estimate, or does that change?
Yeah.
Does your
Yeah,
potential sell?
it's a great question because time goes by, and so what you want to do is you want to go back to your thesis and say, has anything changed fundamentally as the price goes up? Because what you don't want to do is sell a company that hits intrinsic value on stale information. So we're always updating the intrinsic value and making sure that we're working with the most recent information whenever we're making a decision. And that's also true when the stock price goes down. So I might price something in February, and then the stock price goes down 30%. And then now we say it's trading at a discount to our fundamental business value, but we need to make sure that it didn't go down for a reason that fundamentally impacted the thesis. And so we're always making decisions on fresh information. And that's what's great about us all being in San Diego on the same floor, is that it's really easy for us to communicate and get that update from the analyst. Yes.
Returning to your analogy of on the same floor as San Diego,
yeah.
I'm curious, why the Milwaukee office?
Yeah, it's a great question. So we have a small fixed income group that joined Brandis maybe 20 years ago. And so they're responsible solely for looking at that fixed income portfolio. It's nice to have them because if we're finding a company that's in distress, we can leverage kind of the work they've done on the credit side, and vice versa. If they're looking at a bond issue that looks distressed, they can kind of get our perspective on it too. So there are some synergies there, but it's not fundamentally what we're doing. All right, any other questions? By the way, did I answer the question? Okay.
Well, the dot here, complete sale.
Yeah.
I mean, that's a requirement, and when the price hits the top of your value, you're just going to sell it.
It's not a requirement because there are some businesses that's going to be where when you're thinking about sources of cash. Let's say the Mexican stock exchange gets presented to us because Mexico is getting scary. We just bought that, and it's trading at a 30% discount to what we think it's worth. The sources of cash are going to come from the businesses that are selling at that intrinsic value. Now, some businesses are higher quality than others, so if it's a good business that compounds value over time, because even if you buy something at that intrinsic value estimate, every year it should go up 10% if you're underwriting at an equity return. So if you've got a solid business, it's a grocer, it's cash flow generative, maybe that's not the first one I sell, maybe it's the one next to it that also is at intrinsic value that's a bit more cyclical, or maybe its competitive position is a little more in question. That would probably be a quicker sell than a grocer.
So I just wanted to mention, it's about an hour is about the time that we expected the presentation to be. So love the questions. I think it's really great. We got about 15 minutes left.
Okay, great. All right, perfect. So we only have a few more slides to get through, and it's really just the process. So I think we.
And we want to remind you to use your mics too, if you can.
Okay.
Yours should be on down there. You guys should be good, but for the trustees.
Okay. So the next slide and the next couple slides, we can go quickly through them. It's just, how do we actually price a business? So these are the factors that we look at. It's a very holistic approach. Again, we want to think like business owners. We're willing to own these for a long time. So we're not just looking at a couple statistics that are going to drive price in the next 3 months. We're not looking for catalysts. We're just really trying to price the business first. We're looking at industry factors. How does this company fit within its industry? What are the macro issues you need to think about? Is the industry going through the peak where it might be over earning? So some companies trade at low PE because the market's skeptical that those earnings are sustainable. So we need to make sure that we're not just buying a low PE stock for the sake of it, but are these earnings sustainable? So those macro factors will help us understand, what could be distorting earnings. And vice versa, right? If you're going through COVID period and aircrafts can't fly, no one's ordering new aircraft, what is the earnings going to look like on the other side of the cycle? So that's a deep part of our analysis. And then country factors. So every country has its own political risks, institutional structures, inflation issues. And so we want to think about how does this country differ from another country that we can invest in, so we can equalize the valuations and make sure they're apples for apples. And then there's other factors, is the company following the rule of law? Is there cultural issues that might make us get concerned about, the accounting quality, et cetera? So you put these all together, and that's going to be that holistic approach I'm speaking of when we're pricing businesses. And if you go to the next page, once we sort of take that all into consideration, there's a research report that's produced by the analyst, and then we're going to be consuming that research report ahead of our meeting. In the first half of the meeting, we're pricing businesses, and then in that period, we are debating with the analysts what are the key value drivers, what are the key risks, and trying to get to intrinsic value. That the committee is using the analyst's work, but we're establishing our own estimate. So the analyst is recommending an estimate, and then we arrive at our own estimate after that robust discussion. And really, our intrinsic values are not that different from the analyst. I think where the value add is what is the good buy price? At what point can you buy that business at a price that compensates you for the risks? And that's really where the committee adds value. And if you go to the next page, this is the construction process, which is the second half of our meeting, and this is where we're now ranking companies by margin of safety. So if you look at the y-axis that's going up and down, the higher the margin of safety, the higher the allocation will be. And then these other factors that go across on the x-axis are also going to be part of the discussion. So it's a multivariable approach. Not all margins of safeties are made alike. So if you've got a beverage company at a 30% margin of safety, that's a pretty good buy price, because you can be fairly confident that beverages and demand for, alcohol or soft drinks are going to be very stable, whether you're going through a recession or not. Cash flows are very stable. So if you're getting that discount with a stable cash flow stream that's durable, you can have a lot of confidence. If it's an auto part producer who's competing against other global peers and there's questions about their core customer and whether they technology electric vehicle versus internal combustion, like, you need a much bigger margin of safety to get comfortable with it. And so that's how we're going to think about it, and then that's going to drive our allocation decision on after assessing those factors. And then this is the top 10 holdings. We like to put our capital to our best ideas, and so this is a good snapshot of where we're finding the best value. Again, we run fairly concentrated portfolios, 70 names currently. The top 10 are 30%. I can go into any of these if you like, maybe in the Q&A if you guys have any questions on these, but just wanted to point out that that we do like to put our capital to our best ideas, and it's probably not a surprise to see aerospace names given some of the things I've talked about following the COVID lockdowns. And then I'll just end on this slide. This is the fundamental characteristics slide. And it just shows that despite the strong returns that we've been seeing the last couple of years, so we were up 40% 2 years ago and 25% last year, this portfolio still looks attractively priced. It's got a 10% earnings yield, so that PE ratio, the inverse of that is the rate of return you're getting for the earnings that you're buying. So that's 10%. It's 5 times cash flow. Dividend yields, 3.5% almost, and rising. And a lot of the companies that we were buying the last several years have been reinstating dividends, and so we would expect that dividend to continue to increase. And basically, the reason we're able to generate this attractively priced portfolio is because we are rotating capital into an asset class that's been out of favor. So while we've been generating high returns, international small caps have, I think, at the last 10 years, last 7 years, 5% returns. They should be generating much higher rates than that, given the rate of earnings that they're producing every year. It's just been out of favor because values underperformed growth, large caps outperformed small cap, and so we're able to rotate capital from the things we were doing during COVID into new ideas that are emerging. So it's all in there, and if you guys have any questions, we're happy to answer them.
You mentioned the lessons learned that you've looked back since 2009. What is the greatest pair of lessons that you've learned? Yeah.
I think having a too hard pile, I think, is a good lesson to have. Value investors love a falling stock price, and we are doing robust analysis, but it's easy to talk your way into an investment idea if there's a lot of upside. And the question is do you have a crystal ball to be able to predict what's necessary for that upside to occur? So when you look at some of the decisions we were making in 2005, they're restructuring, there's names that are screening very cheaply, so low PE, restructuring stories, so we can get our head around that. You spend this much money on closing a facility, that gives you this much cash flow that's going to come on the other side. You can work through that. But if there's a recession that happens before they get through the restructuring, then you take a zero, especially if there's a balance sheet issue that's layered on top of that. And so what we were realizing is that we were being speculative, not investors, right? So if I'm speculating on an upside case, but I have to have a crystal ball in recession, that's not our edge. So maybe you just put that in a too hard pile and you go to a name that's not as statistically cheap, but you're not taking that risk. And I like to think of it as a boxer with two hands. So, if you're only punching with the upside hand, you're not going to win very many boxing matches. And so we found ourselves that we were increasingly tying one hand behind our back. So the preservation of capital principle is much stronger today than it was in 2005, 06. And to me, that's the biggest lessons learned. But there's a ton of them. So the benefit of doing this for 25 years is that you make a lot of mistakes that you can learn more than one lesson. But that would be one of the top ones.
Thank you.
Yes.
With the factors that you consider, the environmental, social, and governance, and then you're investing a lot in defense and aerospace.
Yeah.
How does that jive?
Yeah. So when we think about ESG, we think about how does that impact the business value? And are there risks arising that could impact business value? We want to incorporate those risks into assessing business value. But we're not going to exclude a name because it has an ESG factor unless we think it's going to impact the preservation of capital, like it could be a 0, or are we not incorporating to intrinsic value? So that's how we think about it. There are some clients, particularly in Europe, that will say we don't want any aerospace and defense, and they will restrict us from buying it, and we will accommodate them. But for clients that don't have those restrictions, we're not going to exclude names unless the risks are so high that we just want to move on because it's too hard to price it.
Jerry.
Just a quick question about working with the Canadian, I believe.
Yes.
And the current situation regarding tariffs. How is that impacting your thinking?
Yeah, so it's something we're thinking very deeply about. It's an issue you don't want to ignore. So it's going to be, how does it impact the specific company you're looking at? Now, what's happening is that the market tends to shoot first, ask questions later. And so a lot of names will sell off because it's in a country that might be exposed, like Mexico. And so Mexico's currency is down 30%. Its stock market's been down. It's certainly out of favor. It wasn't too long ago that Mexico was one of the hottest asset classes in emerging markets because people recognized that this onshoring that the U.S. wanted to do from Asia would be beneficial to Mexico and Canada. Well, that's shifted pretty dramatically. So we were reducing our Mexico exposure into that sentiment increase, and now that sentiment's turned, we've been increasing our exposure to Mexico. Now, we're not saying we're going to buy this company that is first derivative exposed to trade, because I can't predict this. No one can, right? You put 100 economists in a room, 50 might say yes, 50 might say no. But I can go buy the Mexican Stock Exchange. I mean, this is the crown jewel of any country. It's a natural monopoly. It's a platform business. There are network effects. The more buyers you have, the more sellers want to use it. The more sellers you have, the more buyers who want to use it. And it creates this symbiotic relationship where they can charge a toll on a monopoly, asset light, pays a 7% dividend. It should grow with the capital markets. Outside, in any country, these tend to trade at 25 times multiples. I'm buying it for 12. It's net cash. So we can take advantage of the concerns without necessarily taking the risk. Now, we want to make sure that the companies that we do own aren't exposed, and so we're going through that. Fortunately, most of the businesses that we own are market leaders in their home countries, like telecoms or the beverage company I'm speaking of, or grocer, which aren't subject to trade issues. And so, fortunately, we don't have that much exposure.
Thank you.
Okay, you're welcome. Great question, too.
Other questions? Trustees, any further questions?
Any questions from Callan?
I believe they're muted.
I think we're good. No,
Great. Thank you. Well, many thanks for inviting us to join you today. We really appreciate the opportunity to share our story with you and to be considered. If there are any further questions, Robert, please don't hesitate, or to our friends at Callan, thank you for the work that you've done as well. So have a great day today. I'm sure it's a very active one for your committee, and yeah, we look forward to hearing the news down the road.
We'll be in touch. Thank you.
Thank you very much.
Thank you, everybody. Appreciate it.
thank you.
I don't need that.
Oh, okay, great. I'll take that back from you. Thank you.
Alex, it's 10. Do we want to take a break?
Yes, but I want to do through the end of the day first, which we're almost there. Is there any board discussion on this item that we would like to have at this point? Nope. Okay, and then I need to call for public comment.
There actually is no public comment.
Okay, having no public comment, I believe we should take a 10-minute break before we go to item B, 4B. So let's meet back here at 10 after 10.
Great. Thanks. okay.
Only if CHP asks us for help.
Scott's ready? Are we ready?
Unchanged.
You want to stand here?
Yeah, right there. Take your seats. Hi, everyone.
Hello.
Caroline,
Hi there.
trustees.
Yeah, Scott's always, he's on it.
Paper copies for anyone
So
that
please
would
don't
like
leave.
one.
No,
Welcome.
thank you.
And just a reminder to trustees, when you ask questions, use your microphone.
Remember, the green light is on,
Green light's on.
and let's begin our next item.
Can help you clap.
Okay.
Here, I'll take, yeah.
Item 4C, AQR Investment Small Cap Presentation,
I have my,
International Small Cap Presentation.
Copy.
Carolyn Wallace and Dave Kirshner. I'm good, thank you.
That's right. We do have it on our computers, so we're good.
They're heavy stock, so they can also be used to kind of bat away, stray dogs and whatnot.
Yes. I have 2 extras if anyone needs them.
Welcome.
Yes.
Okay, so Carolyn Wallace and Dave Kirshner,
That is us.
Hi. AQR. You may
Excellent.
begin.
Well, thank you all for the opportunity to come present in front of all of you in beautiful Mendocino County. As 2 people who got off a flight yesterday from very cold and gray Greenwich, Connecticut, I think I can speak for Dave when I say that we're really thrilled to be here. You're going to hear quite a bit from us on our international small cap strategy over the next 60 minutes. But before we jump in, I think some brief introductions are probably in order. My name is Caroline Wallace. I'm a vice president on our institutional business development team here at AQR, responsible for looking after investor relationships on the West Coast as well as in the Northeast. And I'm joined by my colleague, Dave Kirshner, who is a managing director and a senior member of our global stock selection team, responsible for AQR's international small cap strategy. So Dave and I's collective goal today is to arm you with as much information as possible about what it is that we do and how it is that we do it, such that you as a board feel well equipped to make the best decision possible for yourselves and for your stakeholders. Over the next 60 minutes or so that we have together, we're going to do a deep dive into our investment philosophy, our investment process, and our 17+ year track record of outperformance in the international small cap space. But if we get to the end of those 60 minutes and you remember nothing else, I know it's a long day, we're really here to emphasize 3 things. And I'm actually going to start, I think it's slide 7. I'm going to start with the punchline, really. We're here to emphasize 3 things. The first is that AQR is experienced. We have been managing long-only international equity strategies for large institutional clients for almost 25 years. And we manage over $4 billion for California public plans, just like yourselves. The second is that AQR is risk controlled. Our highly diversified process harnesses hundreds of independent alpha signals and allows us to size and scale risk appropriately in international markets, such that we can minimize or completely eliminate unintended exposures or concentrations. And then last, we really walk the talk that we are a partner. We, put simply, believe that informed investors make better decisions, and so we treat our clients as our partners in a mutually beneficial intellectual value exchange in service of what really is our shared goal. So before I give the floor to Dave to do a deeper dive into each of those 3 points, I do want to spend a couple of minutes just zooming out and framing AQR as an organization, because I think our DNA as a firm really informs everything that we do. And so if you jump back to slide, I think it's slide 5. I don't have it right, perfect. So at the risk of stating the obvious, AQR is a quantitative asset manager. I don't know if you've run across many quants, but we're not known for our creativity. AQR does quite literally stand for Applied Quantitative Research. But what I think is really important to emphasize when it comes to AQR is that there are all types of quants. And we like to think of ourselves as quants that are heavily guided by and grounded in economic intuition about markets. The quantitative part of what we do is really maintaining the discipline to systematize those insights through our quantitative models. Now, the type of economic intuition that we look to systematize through those models has deep roots in academia. Two of our founders, Cliff Asness and John Liu, actually met at the University of Chicago's PhD in finance program, where they studied under Eugene Fama, who is widely considered one of the founders of modern portfolio finance. Cliff and John would leave and join Goldman Sachs' quantitative research division, where they would meet our third co-founder, David Kabiller, before all three would leave in 1998 to formally found AQR. Now, believe it or not, looking at us today, AQR launched in 1998 with under $1 billion in assets and a single multi-strategy hedge fund. But fast forward to today, and we manage well over $114 billion for our investors around the world, which include individuals, family offices, endowments, foundations, and retirement plans. We're now 600 employees strong across 7 offices globally, and I will just emphasize that all of our research, trading, and portfolio management is centralized in our Greenwich, Connecticut headquarters, where Dave and I both sit. The other 6 offices around the world are purely for business development and client service. Our asset base itself is quite diverse, with roughly 60% of our asset base sitting in traditional equity strategies and the remaining 40% in alternatives, broadly defined. So I think if we can click forward one slide. So I always like to end my introduction of AQR on, on this slide, because I introduced the firm by saying that our DNA really informs everything that we do. And I think nowhere is that more apparent than in the fact that in many ways we are a 25-year-old startup. We're still a founder-led company with Cliff Asness and John Liu jointly leading our portfolio management and research divisions, and David Kabiller heading up business development and client service. So I'm going to pause there before I pass the floor to Dave to do a deep dive into the strategy. I'm happy to take any questions now about the organization, our history, things of that nature, or we can save questions for the end. Okay, excellent. Dave, over to you.
Okay, great, thank you. And yeah, I just want to reiterate, and maybe we can just go to a really exciting divider slide. I think 2 slides ahead of this one. There we go. AQR performance and perspective. Plenty to say on this page. Before I get into sort of the distractions with all the numbers and charts and everything, I just want to maybe reiterate something that Carolyn said. So AQR, we're a quantitative/systematic manager. That's what our roots are. But bottom line is, in order to demystify that, the way I think about it and the way our philosophically our process is aligned is that we believe in fundamentals first. In other words, fundamentals drive stock returns and stock prices. And so we base our quantitative research around determining what those appropriate fundamentals and being able to measure those fundamentals through a variety of different lenses and applying them systematically to stocks. So that's where the systematic and quantitative comes in. We believe ultimately that that investors are best served by identifying characteristics of stocks that come along with what we'll call, in some cases, economic risk premiums, and that's where the academia bleeds in. So in other words, what risks am I taking in stocks that I'm getting paid for versus what risks am I taking in stocks that I'm not getting paid for, and how can I avoid the latter? We also believe in behavioral biases in investors. For example, a news release on a company comes out. There tends to be some sort of response in the market to that news release. Market participants tend to overreact to certain types of information. They tend to underreact to certain types of information. So how can we gather that kind of information, place it with characteristics of stocks, and determine what's most likely to happen across the spectrum: overreaction, underreaction, lack of reaction, and so forth? And how can we invest in a way that appropriately benefits investors, and so forth? Another thing that we firmly believe is that if you apply these similar types of characteristics, broadly speaking, to a highly diversified set of stocks, the reliability of your outcomes becomes higher and higher over time. In other words, you have more chances to have positive outcomes and fewer chances to have negative outcomes. And so we actually design our process to control these types of risks with all these kind of ideas in mind. Number one, reduce risk of concentration in one particular stock, which could go up or down at any point in time by diversifying across hundreds or even thousands of positions. Not taking strong country biases in our portfolio. This is an international portfolio. However, we don't take particular country views because macroeconomics tend to drive performance of individual countries, one versus another, over much shorter time horizons than we can efficiently capture with a highly diversified stock portfolio. So we'll avoid taking unavoidable risk. We do, however, take some industry or sector risk, but we do that in a very controlled and very process-oriented fashion. And last but not least, when speaking about risk, we have a forward-looking risk model that allows us to manage a portfolio with specific return and risk objectives versus the benchmark that, again, will allow the portfolio to generally outperform, we believe, over time, but avoid large degrees of underperformance. You know, it's nice to capture the good upside, but we want to avoid to the extent possible the downside, and we do that through, again, a risk-controlled process built on diversification. So what are you going to hear from me today? You're going to hear a little bit about systematic investing, how we think about systematic investing at AQR. You're going to hear a lot about fundamentals, diversification, and risk control, particularly when it comes to risk that you're not being paid to take. So on the next slide, thank you. This is our recent performance. Now, we've had a couple decent years recently over the 1 and 3 year period, and I'll explain where that sort of outsized performance came from. We think that there was actually a catalyst that drove that somewhat exceptional performance over the last couple periods. But we've been running this fund since 2007, and the since inception track record has shown that we've been able to outperform the benchmark by about 250 basis points, about 2.5% per year since inception of the strategy, roughly 18 years ago. Way down in the bottom right-hand corner, there's a lot of numbers on this page. I'm just going to focus on that 2.9% tracking error. That's within the bounds of our tracking error target. So how much are we going to track the benchmark plus or minus? And you'll see that there's actually not that many years where we're outside of that range. So again, we're looking for reliability of results. Reliable outperformance, but reliable bounds of performance to avoid those situations where the portfolio will, to a large degree, underperform the benchmark. Those are the ones, no one's that upset when things work in the other direction, but we want to avoid the underperformance in the downward direction. So before I get into the portfolio process specifically, on the very next slide, just play a little bit of a math game. We can't help ourselves. We're quants, right? So this does bear on our process, but this is more of a stylistic type of explanation. So imagine you have a manager who is slightly better than average. In other words, this manager can pick stocks that are going to outperform the benchmark about 52% of the time. It's a little bit better than half. About 48% of the time they underperform the benchmark. Thank you again for coming.
Thank you.
Good luck today. Thank you. So we think of diversification as our first line of defense. What we show here is different bars that if that same manager who has a 52% success rate, slightly better than average, applies a similar process to more and more and more stocks across an investment universe. So if they just pick one stock for their portfolio, they have a little bit better than an average chance of picking one that's going to outperform. A 48% chance of underperforming doesn't sound that great. Simply by applying that process to just 10 stocks, we see that reliability increases to 55%. And we go further and further and further to the right on the chart, simply by applying a process that's a little bit better than average. Within the 200 to 500 stock range, the reliability of outperformance jumps from 52% to somewhere between 70 and 80%. So simply applying a process that's a little bit better than average to picking stocks, but doing so over a broad swath of stocks increases the reliability of outperformance. And so these are the types of risks that we engage in at AQR through our quantitative process. Applying a process that's quite honestly probably better than that 52% that we're estimating here, to reliably pick a portfolio of stocks that at the end of the day is more likely to outperform. And just to put this in context, one of the greatest stock pickers of all time, Warren Buffett, had a reliability, or had a win rate of roughly 55%. So he was a little bit better than average. But he wasn't picking stocks 90% of the time that we're going to outperform. So this just gives you context. A better than average process, or an even better than average process, which we believe we have at AQR, applied through diversification, increases the reliability of potential outcomes. And so how has this actually played out in practice? On the very next chart, we show what we call a batting average chart. And what we see is I'll call it the northwest because we're here in Northern California. To the northwest of this line, we see blue dots. And these blue dots are 12-month rolling periods since the beginning of the strategy where the portfolio has outperformed the benchmark. The purple dots to the southeast represent 12-month rolling periods of time since inception where the portfolio has underperformed the benchmark. And this equates to a roughly 73% batting average. In other words, 73% of the time, 12-month periods, rolling periods since inception of the fund, the strategy has outperformed versus 27% where it's underperformed. This is, again, just putting the last page into some context. And again, I believe that we are actually, and evidence shows that we're better than 52% at picking winners over losers. But when we apply our process across a broad swath of stocks, a broad diversified swath of stocks, this is the type of outcome we've actually been able to achieve over almost 20-year track record in the strategy. So now let's talk a little bit more about research and our investment philosophy at AQR. Thank you. I won't spend a lot of time on the divider slides from this point forward, so thank you. I'm not going to talk about each one of these boxes, but just a little bit about the research team at AQR. As Carolyn already mentioned, the founders at the firm are still very much involved in our research effort. That's Cliff Asness and John Liu, whose pictures we saw on a couple pages ago. But we actually have a very collaborative, very well-resourced research team. We actually have 3 research teams at the firm. We have my stock selection research team, we also have a macroeconomic research team, and we also have a merger and arbitrage research team. But we're a very collaborative organization. So within these research teams, if you incorporate portfolio managers and programmers and a whole cadre of individuals, we have roughly 250 individuals in research at the firm. It comes out to nearly half the firm employed in some form of research and portfolio management. When we say collaborative, it's truly collaborative. If our macro researchers develop through the process of exploring macroeconomic trends or macroeconomic ideas, a way to enhance the stock selection process, they share that with us, with my team. Vice versa, and I'll give you a specific concrete example, we understand that while they may be looking at markets, broadly speaking, US market versus Australian market versus emerging markets on the macro research team, if we find a way that we can assist them with their research process and the stock selection research, we share that with them openly as well. And the specific example is comparing indices or comparing markets is very different than comparing the constituents that live within the markets. And since we're studying stocks in stock selection, it's important to share the characteristics that we're exploring in stock selection with our macro team so they can make better estimates of where macroeconomic directions different markets are taking based on the equity market information that we're able to discern. When we say well-resourced, my background is I was originally an aerospace engineer in Southern California. And I moved into finance and worked as a practicing portfolio manager at a systematic manager who you may or may not be meeting at some point today for about 15 years. And then I came over to AQR with background in engineering, computer science, and practical hands-on experience managing broadly diversified stock portfolios. We also hire in our research team PhDs with economics and finance degrees to give us that economic and financial grounding that we think is so important to deriving stock returns and other asset price returns. We also hire people who have mathematical and statistical backgrounds. Why? Because it is, while we are a quant and we base all of our ideas on fundamentals in economics, it is important to understand the relationships of these different ideas through the lens of statistical analysis. And last but not least, we hire practitioners, people who have accounting experience, people who have worked as sell-side analysts, who have actually gone into companies and talked to management and written research notes, so that when we consume this material, we understand the context of the material that we're consuming so we can apply it to our quantitative model. So we think of ourselves as well-rounded and resourced, anchored in financial and economic ideas, but with a broad range of people that are all serving the same goal, to have investor portfolios that are able to systematically beat the markets with controlled risks. Yes, sir.
How do you account for the various international accounting flavors?
So this is in terms of international accounting flavors. Number one is that we, first of all, attempt, and I'll talk a little bit about some of the characteristics that we look at. We attempt to find characteristics that are very robust to what I'll call alternative specifications. That's just a fancy way of saying if you measure operating income in 3 different ways, and depending on which way you measure it, the results of company performance based on operating income are different, then that's not a particularly useful measure from our standpoint. So what our researchers do is they attempt to create numerical ways to adjust accounting standards across different industries and across different countries, so that when we apply these standards to our portfolio, we get similar results. If that's not achievable, these are typically data sets that we don't consume or utilize. They may be useful to know about, and they're something that we want to keep in the back of our mind for future research. But generally speaking, our goal is to use a process that is broadly applicable across different markets and market capitalizations in order to avoid data mining or data searching that might give us spurious results that just happen to be because of a particular quirk in an accounting standard. So we do make adjustments, but we try to make them with an economic rationale, and we try to make them comparable. And if something requires an adjustment to work, and it does not work on a standalone basis, it's probably not something that's going to find its way into our model.
Thank you.
Thank you. So I'll talk, I'm going to spend a little bit more time on this slide, and then I'll kind of move a little bit more quickly through the rest of the presentation. This is actually a high-level description of our research process, but it also really mirrors our portfolio management process. So what are our researchers and portfolio managers focused on a day-to-day basis? First, I'm going to break this into 4 different boxes. Characteristic identification. I mentioned before that we're fundamental investors. So what does that mean? What sort of fundamentals do we actually look at? Well, you can actually kind of think about this as a spectrum. We look at raw fundamentals. We explore balance sheets, income statements, cash flow statements, and so forth. We apply that across different industries and across different countries. We think that healthy companies that are attractively priced and have growth potentials in the future, that are favored by informed investors, will tend to outperform companies that have the opposite. And so we'll tend to hold the companies in excess weighting of the benchmark that have those properties I just described, and not hold or underweight the companies that have the opposite of those properties: expensive, deteriorating fundamentals, weak fundamentals, and so forth. We also look for what I'll call governance measures. So we actually explore what management says they're going to do versus what they actually do in practice, and we ask ourselves a question: is this beneficial to shareholders, or is this beneficial to management? When management offers to have a share buyback, are the shares outstanding at the end of the day less in the company, or are they the same? The latter implying perhaps management was just trying not to dilute options that they were going to pay themselves with at some point. So we look for shareholder-friendly responses to management. We look at informed investors in the marketplace. Where are hedge funds putting their money? Where are mutual funds and allocators switching money to? Are they going from value to growth? Are they going from small cap to large cap? And we try to understand the market forces that are driving particular markets or particular industries or particular stocks to outperform through the lens of other informed investors in the marketplace. And then we also span all the way to what I'll call the more esoteric and mathematically based types of models, where we actually have created what we'll call, and this terminology is out there all over the place these days, but large language models. In other words, these companies, there's hundreds and thousands of them, produce analyst reports, feed into news reports, are customers and suppliers of other large cap companies that are well known. So how can we consume information related to news regarding these companies, broker reports or management reports according to these companies, that will allow us to estimate over short-term horizons and medium-term horizons and longer-term horizons how investors are going to react or overreact or underreact to certain types of news events. So again, we're looking at characteristics and fundamentals, and this is where we put a lot of our effort, that will, through economic and through financial means, drive medium to longer term stock returns. And these are going to be the raw data that we use in our model to be able to determine what stocks are more attractive for the portfolio versus what are less. Signal construction is sort of a parallel to characteristic identification. So how do we translate this raw data into something that we can consume in a model? For example, if we're looking at valuation ratios, which we think are important, book to price and price to earnings ratio. Do we want to look at companies compared to all other companies in the marketplace? Do we want to focus on specific industries? Because, for example, going back to the accounting standards question, maybe software companies in Amsterdam or in the Netherlands are valued in a different way than software companies in Japan. Or maybe their accounting is different. Do we want to compare the relative values of the accounting in different regions in a different way to be able to discern which ones are actually attractively priced and which ones are unattractively priced? So our signal construction looks at how we can build on characteristics and make them more economically comparable across different markets and across different market capitalizations, across different industries, so that we can make a true determination whether stocks are attractive from a growth in fundamentals, from a relative pricing standpoint, or from an informed investor standpoint. Once we have all these signals and characteristics, and our process involves something in the neighborhood of about 250 or so of these different types of characteristics, the model construction speaks to how we combine these at the final model level to determine, because at the end of the day, we're buying stocks. We're going to go overweight some stocks we think are going to outperform. We're going to go underweight stocks we think are going to underperform. So what do we care about more or less? Do we care more or less about growth and fundamentals, stability of fundamentals? Do we care more about valuation ratios? And how should what we care about change over time? I'll give you the short answer to this, and we'll talk about it in a little bit more later. But for the most part, we look at very long data series, and we say, how predictive is each piece of data in our model about future stock returns, and how much diversification does that offer across the whole portfolio? And the basis of our weighting scheme is going to be the long-term predictability of these individual characteristics of future stock risk and return. However, we do recognize that markets don't always trade rationally, and we'll actually see when we talk about performance historically that there was a period of recent period, 2018 through 2020, where we believe markets traded far away from fundamentals. And during these periods of time, do we want to ignore the fact that the market considers other characteristics more or less important, or do we want to actually understand that and adapt it into our model? And so while we do focus mostly on the long term, we allow our model some short-term timing aspects that's empirically based, saying that markets today may be trading on different information than they have historically over the long term, and to modulate those long-term views very, very modestly to be able to take into account what's actually occurring in the market at any given time. Yes, sir.
Having gone through my stat at the University of Minnesota and Dr. Cook's influence, groundbreaking influence, how do you handle influence in your modeling?
Influence?
Yes. Influential observations that may just be one or two, but really heavily tilt the model.
Yeah, so it's like with our stock picking universe. We believe diversification is key across all of our processes. And so the ultimate goal of our portfolio formulation process, whether we're talking about the individual characteristics or how we weight these characteristics together in the portfolio, is that we want to get diversification. So, give you an example, and we don't have to jump ahead in the presentation. We'll get to this page. From 2018 through 2020, we experienced probably the 20 years of the portfolio. Those were the 3 years that back to back that we had underperformance. And during that period of time, there was what we believe a dislocation in the markets, broadly speaking, where there's an appetite for growth at all costs at the expense of healthy, less expensive value companies. It was called a growth bubble. As a matter of fact, that growth bubble was so large that it was actually in excess of what we saw during the the tech bubble, which I remember because that's when I got into investing. During this period of time, our model was very much focused on the very long-term empiric component that the long-term structural component that I described, our model focuses on. So we had about, you can call it about a quarter of our weighting of the model in each of 4 concepts: valuation, growth, fundamentals, and market participants. And within those 250 or so signals or characteristics, we had about an even split between those groups. Now, what was occurring during that period of time is that everything in that valuation bucket was telling us exactly the same information. It was not diversifying across the model, but our model was steadfastly holding onto that value, onto that weighting and valuation. There were other components of the model that would have been more diversifying. And so what our current model does is allow those to express themselves over a shorter time horizon, but not to the extent that it would have removed all those other longer term beliefs that we had based on long-term empirical and observed and financial data. In other words, new things that were somewhat spurious may have shown up in the portfolio as being more important because that's what the market was trading at over the time, but it only would have very, very modestly modulated away from those longer-term views. So our model, by force of itself, diversification across the numerous characteristics we're measuring, avoids the pitfall of relying too much on something that's very noise-driven, very predictive, but over an extremely short time horizon, because we're only allowed to lean very, very modestly plus or minus into these types of things. Does that answer your question?
Thank you.
No, great question. Okay, so I'll move on a bit. If we go to page 16, and I'm being sensitive of time, this shows our investment process, and it really just mimics the last page that we spent more time on. So, like our research, thank you. We'll just go on to this one. At the end of the day, we're going to have a model that is going to pick every stock in the universe, and it's going to place a weighting based on a variety of different characteristics taken together. The stock that you see on top 5 versus the stocks that you see on bottom 5 are going to represent, on the top, companies that have attractive pricing, growth prospects, both realized and expected in the future, strong and stable fundamentals preferred by informed investors, and stocks that are supported by news up and down the supply chain, not only at the company themselves. The companies that you see that are underweight or not held in the portfolio are going to be stocks that have the exact opposite of what I just described. Unattractive characteristics, unattractive valuation, weak fundamentals, and so forth. And we're going to have a single portfolio of stocks where we're going to go overweight stocks that have what we believe fundamentals that drive future prices, and underweight or not holding stocks that we believe are the exact opposite. On the next page, I'm not gonna go through the wordy pages because I think everyone can read, and you have the presentation books if you want to come back to them. Maybe we can just skip straight to the portfolio itself, which would be on page 20. So I mentioned before that we put certain constraints in place at the portfolio level to avoid taking risks that we believe are avoidable. So first and foremost, we seek consistent gross excess returns somewhere in the neighborhood of about 2.5% or so per year, 2 to 2.5% on a 3 to 4% tracking error. We saw that the realized tracking error in over 18 years is on the low end, roughly 3%. But effectively, what this is attempting to do is we're going to estimate the amount of tracking error versus the benchmark and try to avoid the situation where you get multiple quote standard deviations of underperformance. In other words, we want to avoid those really bad outcomes while being able to have reliably good outcomes on the positive side. Diversification, typically we're going to see more than 400 holdings. The average turnover at a little bit more than, there's a way to think about that average turnover. It says a little bit more than 120%, but most of that is trimming positions. We're going to add to positions that we become more convicted in and take away from positions we become less convicted in. From time to time, we may wholesale sell or buy a stock because it just becomes completely unattractive by our model or becomes extremely attractive by our model. But the way to think about this is that we have an average holding period in the portfolio somewhere north between 9 to 12 months. So we're holding stocks for a little bit less than a year on average. Maximum weightings, we see sector weightings at plus or minus 6%. We do deliberately tilt the portfolio into sectors that we believe are reflective of business cycle activity. So we'll prefer sectors and industries that are on the way up in the business cycle against the opposite, unpreferring sectors and industries that are going down in the business cycle. Stock positioning won't be more than 1.5% plus or minus versus the benchmark. And we take very little country risk in this portfolio. So we're not taking big bets on countries or currencies. And the reason why is because we believe that you can make these types of bets, but it's not very well served in a highly diversified stock portfolio. It just becomes too expensive because macro tends to move very quickly. Macroeconomics tend to move very quickly. And in order to rebalance a portfolio of pure equities into macroeconomics over short time horizons becomes very costly. The next page shows a time series of performance. Oh, yep, sir.
You mentioned a few slides back, nonlinear machine learning versus linear machine learning. About what proportion, and are you willing to say what some types of nonlinear machine learning you use?
Yeah, so you can kind of think about like the way that we employ machine learning is that we take our economic priors. So we don't willy-nilly apply machine learning to our portfolio process. We have characteristics that we have tested through what I'll call econometrics, basic econometrics means. So we say, is growth in fundamentals or growth in operating income a predictive measure of stock returns? What's market reaction to a news report that comes out at a particular point in time? These all have an economic foundation. Once we've developed the tools and the ingredients, we do allow some machine learning into our process in the sense that it can compare it can compare pairwise how diversifying each one of these characteristics is versus the whole rest of the portfolio. Now, when we say linear versus nonlinear, there are relationships that are clearly linear. For example, if I say good news comes out on a particular industry, the stocks in that particular industry will, in general, tend to go up in price. So something really good for semiconductors is something good for the entire semiconductor industry. A linear machine learning model, similar to an econometric model, will be able to make that relationship, and we'll be able to say, okay, well, these particular stocks have this supply chain, those particular stocks have that particular supply chain, so I think these stocks will end up going up more than these. I prefer to have these stocks in my portfolio than those. That's something that is difficult to do computationally as an individual on a spreadsheet or with code, but machines can discern that in a more efficient way. But when it becomes nonlinear, is to say, to what degree is there a relationship between energy stocks in France versus radiography stocks in Japan? That relationship is very difficult to discern unless you're able to look beyond simple econometric and regression types of analyses to like underlying supply chain relationships between the two, economic variables that would affect one versus the other. So the nonlinear machine learning methodologies just sort of break the idea that you have to look for a one-on-one correspondence between one stock and a particular driver of that stock's return. And you can actually look at groupings of things that are not necessarily one-on-one correspondence. It's just a more sophisticated way that we're able to apply machine learning to be able to detect patterns that relate to, again, economic relationships. We enforce that the portfolio must have economic relationships. It's just being able to discern economic relationships that aren't visible on the surface through a learning algorithm. And this is something that's actually new in our process that we're slowly phasing into over the next probably 6 to 12 months.
Thank you.
Thank you. I don't have much more time, so I'll go back to that page if that's okay for 1 second. This is our track record, and you can see out of 18 years, there's only been 4 years where the strategy's underperformed. I mean, I think that speaks for itself in terms of, again, we have a process that makes a lot of what we think are decently reasonable economic bets across a large swath of stocks that gives us a reliable set of returns. There's only 1 year that we had underperformance that would have fallen into that sort of tracking error band of, call it one standard. I can't help myself, one standard deviation, but we're quants. What can I do? I was supposed to not talk about standard deviations, but there you go. That 2018 through 2020 period that you see there was consistently poor performance from mispricing and valuation. I mentioned that there was a bubble that we saw globally that had developed where the market was paying a lot for growth, regardless of fundamentals. And so there was a disconnect between underlying fundamentals and market prices. And we were able to capitalize that in the subsequent 4 years as those valuation ratios came down over time. We anticipated that this would occur. We actually expected it was going to occur before 2020, which is why you see the 2020 is particularly bad, because we kind of locked in the level of valuation in our funds to make sure that we captured that when it came back. So 2020 was actually poor performance because we forced the model to consider valuation due to that large disconnect. But you can see in the subsequent years, outsized positive performance as a result of the valuation ratios coming back down to earth, so to speak. But again, I want to just emphasize the fact that we do control the tracking error, and you can see the historical realized tracking error of the strategy to within that 3 to 4% band. And that's important because we don't want to have, well, we sometimes will give up those extremely large up years. We don't want to have those extremely large down years. That's very important to how we consider our process. The next slide is just a set of characteristics. And what this is just attempting to show, if you look at it, portfolio aggregate on the left-hand side, our stocks on average are cheaper than those in the benchmark because we employ some degree of valuation and mispricing in our process. The bottom two characteristics are growth characteristics. We're also looking growthier than the benchmark. So surprisingly, we're growthier and value-ier. I don't know if that's a word. than the benchmark, and that's by intent. We intend to have growth characteristics that are attractive through fundamentals and price, valuation characteristics that are attractive through raw valuation metrics. And you can also see on the right-hand side that we do have a dynamic nature in terms of what industries and sectors we're leaning into or out of in any particular time. Importantly, because we include valuation in our portfolio, I do want to make a distinction between like an MSCI index. You will find that we're not systematically and all the time overweight. We have been over the last year, but overweight in financials and energy, and always underweight consumer discretionary and information technology. We believe that fundamentals and fundamental growth is what drives business cycle returns to sectors as opposed to pure valuation ratios. And so we don't actually incorporate much valuation between sectors. We do allow some variation in there, however. The next slide is just a sector by sector. This is just an example to show you that we can attribute in multiple different ways. At the end of the day, we want our investors to understand exactly where their returns are coming from. This just demonstrates that about 85% of our stock selection process is coming from within industry stock selection, and about 15 to 20% of it comes from across industry selection, so which industries we're leaning into or out of at any point in time. But again, this is just a sample of one of the many ways that we can attribute performance. You can probably skip that. We don't take a whole bunch of country risk. I know that we're running it right up against time. It's almost 11 o'clock, so
I mean, you're okay to, we started at quarter after, so, we can go till 11:15.
Oh, okay,
Yeah,
okay,
yeah.
okay. Sorry, I had picked it up a little bit just because I had my clock here, so I was shooting for 11 o'clock. But I might still actually end up a little early, and then just ask if you have a lot of questions. Love answering questions. But what is important on here is I noted before that we don't take a lot of country risk in our portfolio. There is some, and I'll explain where this comes from. The reason why we don't in this all equity portfolio is because we do manage portfolios that have specific and explicit bets on particular countries that we think are going to outperform or underperform. Those portfolios tend to employ derivatives because derivatives can be traded a lot more quickly and a lot more cost effectively than heavily diversified stock portfolios. In other words, if we have hundreds of stocks in Japan and hundreds of stocks in the UK, and our model tells us that we want to be overweight UK and underweight Japan, it's costly to trade in and out of those small cap stocks in international markets to express that view. On the time horizons, which typically are in the orders of weeks or a month, that macroeconomic views can shift based on macroeconomic data. And so we tend to not take those risks in our diversified stock portfolios. And we tend to do that with derivatives-based portfolios. And it's not to say that you can't make these decisions, but this is not a risk that we believe that an investor in this strategy would necessarily be compensated for. So what we want to do is we want to limit the country risk so that when something bad happens in the UK and something good happens in Japan, we're not sort of whipsawed about that. The good companies in Japan are the ones overweight, and the quote bad companies are the ones underweight, and so forth and so on in the UK as well. One thing I will note, though, is that there are some differences in the portfolio, and they're small. But one of the ways that we evaluate stocks is we evaluate things across borders. So I'll give you another concrete example. Imagine that there's a radiography company in Japan that inspects chips that are produced by Taiwan Semiconductor. And there's another radiography company that's in the Netherlands that inspects chips that are manufactured by the Netherlands ASML company, right? So these aren't big cap companies. These are small cap companies that are outsourced by the large cap companies I just described, Taiwan Semiconductor and ASML. Our model allows us to look up and down the supply chain of individual companies and to understand who the primary suppliers and who the primary customers are for individual companies. And so good news for the radiography industry may not necessarily be good news for all radiography companies, depending on where their revenue is coming from and who their largest customers and suppliers are. And so what you will see is some country risk as we lean into companies that up and down their supply chain have more favorable relationships with companies that may be in a large cap space or maybe in different markets entirely that have more favorable prospects, and underweight or not holdings at all in companies that have larger downstream or upstream customers or suppliers that have less favorable relationships. So again, our model is not ignoring the fact that there are external inputs into what we should care about when we measure stock characteristics that are outside the individual characteristics of the companies themselves. Very important. We built these networks up over the course of probably the last 15 to 20 years. They're proprietary networks that are associated with AQR, and they do change over time. So, I mean, this is not a great example because it's a large cap US company. 15 years ago, we were comparing Amazon to Barnes & Noble, I think like everyone else. Nowadays, I don't think Barnes & Noble is even one of the companies that we consider when we're evaluating Amazon. It's more like Microsoft and other web service companies as well as online retailers. But we have an evolving network that looks at supplier-customer relationships as well as other economically linked variables that will cause us to take some country risk in our portfolio, because what's good news for one company in one country is not necessarily good news for another company in another country that has similar type of business line. So I kind of will read my conclusion at this point. I think I can't help myself. I've done a little bit early, but my wife at home always tells me, she says, Dave, if you don't have to talk, you don't have to talk. I think my kids appreciate that. So just to kind of recap, AQR, Applied Quantitative Research, we are primarily an economic and financial research company that invests in practical portfolios for investors. The object is to beat the benchmark. The object is to do well for investors in a reliable and diversified way. We diversify away from those types of risks that we believe you're not getting paid for and that we can control and that we're aware of. And we allow the types of risks that we do believe that you're getting paid for because they have an economic grounding. There's an economic rationale for why certain stocks should outperform others. There's behavioral reasons why some stocks do outperform others. We embrace all of that information, but it's based on empirics and financial and economic data. Our research team, again, very strong and collaborative. What's good for me is good for the firm. When my macro team does extremely well, even though I'm in a completely different research and portfolio management team, the firm does well, I do well, I get to stay employed. And vice versa. So we don't stovepipe, we don't keep ideas away from each other. There's not intra-firm competition. So those 250 researchers and research engineers and portfolio managers I mentioned at the beginning, we talk to each other every day, and we're all on the same side, and we're all working for our investors. And I think Carolyn mentioned it too in her intro. One of the things that we really want to do is we want to be a doorway for our investors to better understand how markets and investments are functioning, not only over time, but in recent periods as well. When we discover new characteristics, when we discover new methods of putting portfolios together, we share the information online, but we also collaborate with our partners, and we ask them, the question that we would ask is, how can we make your broad portfolio better? What can we add to the process? Is there something that you would like more information on that we may have in our research database that we're happy to help and share with you at any given time? Very important to us. We not only want reliable outcomes in our investments for our investors, but we want to make sure that you feel like a partner in all the research that we're doing at any point in time. So with that, I will zip it, and I'll just ask if anyone has any questions. Yes, sir.
You talked about the derivative portfolios, and for an analogy, when you use leverage, you are more prone to higher swings. So how do you guard against, when you're using your derivative-based portfolios, some of the volatility?
Sure. So, and just to be clear, the portfolios that we engage in that use derivatives are the investors in those particular portfolios are comfortable with the level of risk that we allow in those portfolios. So it's kind of a feedback. We think that there's a certain level of risk and return that you can achieve in those portfolios given the research that we have on that. And we work with clients who are willing to take that level of risk alongside, or in some cases inform us what level of risk is appropriate for their portfolio. This portfolio does not use derivatives and does not employ any leverage. So just so that's clear. In those particular cases, the way that we size our portfolio risk, well, number one, we have what I'll consider a very efficient way of managing risk in levered portfolios at AQR. We look at them not only from the portfolio level, but also from the firm level and the individual position level. So the brokers and derivative specialists that we work with, derivative traders that we work with, feel comfortable allocating a specific amount of leverage to AQR at the firm, contract, and portfolio level. And we typically will stay well below that, whatever that threshold is, well below that by several orders of magnitude. Also, we have an interesting feedback mechanism in any of our leverage portfolios. As markets become more risky, in order to maintain a similar level of risk, it causes us to reduce the amount of leverage in the portfolio. And that's very important. We do manage leveraged stock portfolios as well as derivative portfolios. And so if we have a portfolio that's intended to run at 10% volatility, market neutral, and that requires us to use 5x leverage, if those markets become more volatile, then the volatility of that portfolio goes up, we reduce the leverage. And so it's kind of a negative feedback mechanism that we use to control risk across those strategies as well. Effectively, we don't want to blow up as a firm, not only for our own self-interest, but also for our investors. But we segregate these. These are separate investments that have their own legal structure. So if something bad happens to a derivative-based portfolio, it won't bleed over into the long-only business.
Trustee Harris, question.
I'm going to explain to both of you. I have a new refrigerator delivered, and it has a little over, I'll say, 10 centimeters clearance in the new kitchen.
Oh, okay.
And it's up there now. But I wanted to ask you about tariffs and any impact, how it might impact your portfolio, and also, or at least how you're looking at various investments. And also say University of Chicago outstanding high school teacher, UCLA, Mensa member.
Nice.
Wow. Small town.
That's wonderful. Wow.
Anyway, thank you, and I apologize for.
Thank you, and good luck with the refrigerator. That's home projects are the trickiest, and that's one that we can't control.
And there's nobody can do it but me.
Okay, well, I wish you the best of luck with that, and thank you.
Thank you.
I will answer your question for the remainder of the trustees.
Great presentation.
Thank you very much.
Safe trip back.
Thank you
Okay,
very
thank
much.
you, and good luck with the refrigerator.
Thank you.
So that's a great question. This is a perfect example of the collaboration between our macro research team and our equity research team. So our macro research team does a number of things. First of all, this strategy, and you saw the performance of the last couple of pages, this strategy has weathered high interest rates, low interest rates, inflation, Russia invading the Ukraine, October 7th in Israel and the West Bank. It's so far weathered the Trump election. I think it's outperforming the benchmark by about 2.5% so far year to date. It's also weathered a number of European elections, which are much closer to home for this particular portfolio, and a Japanese election. So the idea is that, first of all, we avoid risks in the portfolio when we can. And one of the reasons why we use a country-neutral construct and we use mostly industry-neutral comparisons between stocks is because a lot of economic risk has to do with intra-country risk, or inter-country risk, and intra-industry risk. And so we avoid taking large amounts of risk in either one of those two cases to avoid the impacts of macroeconomic events that are out of our control. But we do have a macro research team, and one of the ways that we've evaluated the Trump elections and tariffs is, number one, is where is it going to have the most impact? Clearly, our trading partners to the north and to the south are where the impacts are likely to be most likely. So Mexico has less of a relationship in this portfolio because this is international small cap, and if there's any market that's separated from international developed small cap in Mexico, and any relationship between Mexico and other markets, international small cap is a pretty good place to start. Canada, it's a matter of fact, well, this is an EFI benchmark, so we actually don't have Canada in the portfolio, which is also helpful in this particular case. But we do manage portfolios that are global in nature, and so what we've done is we've looked at what we call impact baskets, where our discretionary macro team will look at groups of stocks and sub-indices and say which industries are most likely to be impacted by Trump tariffs, which are most likely to be impacted by growth policies versus other types of tax policies that might be coming along. It's very unpredictable. And bottom line is that we find that because we're industry neutral for the most part, our process has very little exposure to, quote, baskets of stocks that are likely to be impacted by trade. One of the ones that came as a surprise to me is apparently Switzerland has one of the largest trading relationships with the U.S. vis-a-vis the pharmaceutical industry. And that, again, that's a large cap international thing, not so much a small cap international thing. But we're effectively neutral on Swiss pharmaceuticals in our large cap portfolios, which is what we want to be, but that tells us that we don't expect these to have much impact whether Trump puts tariffs on Switzerland or not. I don't know if that's going to happen, but like I said, I'm not predicting anything at this point. Bottom line is we've weathered it so far, and we don't anticipate anything based on these baskets in our macroeconomic research, but it is something that we pay a lot of attention to, and it's something that we monitor. And always the way that if markets become more risky, the way that our portfolios work is that we take risk away by trimming positions. And since we have hundreds of positions, we'd be trimming small positions. So if markets become riskier, we're going to still be in that tracking error range that we talked about earlier. Yes, sir.
On several occasions, you've characterized yourself as quants, which is an interesting term, which I'm reading what I'm reading into that is that you have a highly mathematical model, and you make your decisions based primarily on your model. If you get new information that comes in that might impact your holdings or your portfolio, would you first adjust your model before making any kinds of changes to your portfolio, or would you change your portfolio and then adjust your model?
So the way that our model works is it's based on a series of fundamental data. So I'll give you some examples of things that we look at directly. We look at price to earnings ratio, industry adjusted. So we'll look at price to earnings ratio of stocks that are in the software industry, price to earnings ratio of individual banks. We look at operating income. net operating income, adjusted for goodwill and intangibles. We look at the variation of operating income over time. So these are all fundamental measures that we use, but the way that we systematize it and the way that we make it quantitative is we say, okay, now we have a model that says companies that have strong fundamentals, growing fundamentals and so forth, that are attractively priced should be overweighted in our model. We should be holding these stocks in excess of what the benchmark holds. And companies that have the opposite characteristics, we should be underweighting or not holding at all, right? And so what the model does is combining these measures and saying, I want to think about the level of my fundamentals and the growth of my fundamentals, but I want to also care how much I'm paying for it, and I also want to care how much other informed investors, what are other informed investors are doing? Are people moving away from this industry? Are people moving money into this industry? And so the model is going to take these economic and accounting and price-based factors together, and it's going to say, based on all these characteristics, I want to hold more of these stocks or less of these particular stocks. And the way that the model changes over time is two ways. Number one, we develop a new characteristic, and that usually takes somewhere between 18 to 24 months, and about 95% of these new ideas are thrown out. A data vendor comes and says, we have a way to predict that guaranteed you can consume Japanese small company broker reports, and it's guaranteed, 9 times out of 10 you're gonna predict outperformance. Well, we'll test that for 24 months, and if we're not getting what we expect after 24 months, as I said, about 95% of these data sources just go into garbage. We don't ever use them. So we're pretty certain that something that comes into our model is somewhat predictive and has an economic grounding as to why it would be predictive of stock prices. And the model itself is going to very, very, very slowly modulate what things we care about more or less, but it's going to care about all these things together. I don't want just cheap stocks. I don't want just high quality stocks. I want high quality stocks that are also cheap, that are also showing growth, that are also favored in broker reports and these types of things. So the model itself, mathematically based, but it's based on combining fundamental and qualitative and quantitative measures in such a way that very, very slowly changes over time based on current market conditions and based on our conviction is how much information, how important is each piece of information to determining which stocks we should like or dislike. Does that answer your question?
Yeah, somewhat.
If there's a piece I missed, I definitely want to.
No, I have one follow-up question. What is the opposite of a quant? There's got to be a term, and I need to know it.
Well, we call them a lot of different things. None of them are good. No, I'm just joking. We find that as quants, our process can be very complementary to what we call discretionary managers. So a discretionary manager would we believe a lot of the same tools that we use, but do it but not necessarily do it in a way that's applicable to as many stocks. So we think our model's never going to pick the perfect stock. We don't have very much conviction in which stock is the best and which is the worst. But we have a lot of conviction that on average, these types of characteristics outperform those types of characteristics. And so when we can apply that across hundreds of stocks, that's when we get good outcomes, as opposed to saying this one and these two stocks are really good, these two stocks are really bad. Our model doesn't function as well in that environment.
Okay. So what's the level of discretion, human discretion, I guess, outside of the model, right? You're using fundamental characteristics that you're measuring in some way, it's feeding into the model. And somebody's, sitting in a room somewhere saying, okay, this model is predicting as kind of as we expect, right? I mean, what's the level of that potential human intervention?
So it's actually very low, but I'll tell you where it becomes important. When we identify characteristics that go into the model, the level of discretion is high. So if we have a data set that I have a PhD researcher who absolutely loves this data set, they're convicted this thing is very predictive of I've been working on this for 2 years, it's got to go in the model. They have to present that through a very systematized series of it's almost like defending a PhD. You have to go through first your professor, then 4 other professors, then the entire research team, then Cliff and so forth. During that period of time, there's a lot of, I'd say there's more discretion as to which signals get rejected and which ones get accepted based on out-of-sample testing, stress testing, and so forth. Once it's in the model, we try to take away the discretionary aspect. Once we've said that this is actually doing something, then we allow the model to make the decision. Should it be weighted more? Should it be weighted less? Should it go away? Should it not go away? However, it doesn't mean that we're letting the portfolios run themselves. We manage our portfolios every day. We run our model every day. And every day we compare the model to the portfolio. So in an ideal frictionless universe, what would I buy today if I had no trading costs or anything versus what's actually out there? And then I look at those constraints that we showed on that page. If I'm violating a constraint, or if my portfolio looks very different than the market, then a portfolio manager who looks at all these different outliers and all these different risks that that we don't believe that you're getting paid for, will say, okay, listen, we have an issue. We're using measures we're using measures on the shorting market in Germany. Germany just said there's no shorting of stocks. Okay, so our model's using data that's no good. At that point in time, our investment committee, we have a very structured investment committee and portfolio managers and a risk team risk team's actually independent of portfolio management. We'll be looking at these things and say, listen, we can't be using shorting data because it just simply doesn't exist in Germany. That's a discretionary override that will take place. And during COVID, that happened. It was not Germany, I think it was Spain and Italy. But we stopped trading on data that just was not becoming refreshed because it didn't make any sense. If there's a corporate action, we don't trade on corporate events in the portfolio.
Okay, so a lot of discretion feeding into the model, less so once the model's sort of operating as expected.
Yeah, unless it's something that's out of our control that's occurring in the market, which we're monitoring, in which case we'll say, okay, let's not go buy companies based on short data because shorting's not allowed.
Sure. All right, great. Well, about 11:17. So, trustees, any final thoughts, questions for AQR?
A personal question. Since my bachelor's was in electronic engineering microwaves,
Okay.
what was your specialization concentration in electrical
and
engineering?
I'm not just trying to butter up, but it was actually microwave. I went to Penn State and studied under Professor Lynn Reynolds, and my thesis project was a conformal microwave antenna that used GPS signals. So I was a microwave guy. This is great. We should catch up sometime.
Thank you.
Thank you very much. I really appreciate your time today. Would you like to keep these, or we can take them with you? You can keep the ones that you have. I just are extras.
You can keep them if you need. We'll shred them.
Okay. Yeah. Sometimes people just don't want to carry our, let's.
We'll leave them and.
Thank you, everybody. Really
No hard feelings if you shred.
Thank you so much. I really appreciate it. Yeah. Thank you.
I'll bring my water with me. Can I shake your hands?
Yeah.
Thank you very much. We really appreciate it. Thank you.
Okay. Is there any board discussion at this time? Does anybody want to make any comments about AQR's presentation?
I really enjoyed it.
Okay.
I like that.
Well, is your microphone on?
That's all right.
Well, it seems like they have a system.
They have a system, a rigorous system that's both positive and negative. I think Robert's question was better phrased than mine but it was the same in terms of how much leeway do they have to diverge from their own model and how rigorous is their adherence to their model, which was, I think, important because things change and models are good, but they're not infallible. Is there any other discussion? Okay, at this point, I need to call for public comment. Is there any public comment?
There is no public comment.
Okay. So
we've got Causeway on
we
the
have
line
Causeway.
here.
I would like to see if we'd like to take a short break. That's a lot of information we just had. Is a short break going to be okay if we meet back in 5 minutes?
Can we run through this maybe the next hour and then take a short break?
We can, if that's, I wanted to see if there was an appetite for a short break. If not, let's move on to item 4D, Causeway International Small Cap Presentation. Cullen McGarren and Ryan Myers online.
Hi, everybody.
Hello.
Can you hear us okay?
Yes.
Perfect. Well, it's nice to meet everybody virtually, and apologies, we couldn't attend in person today, had some issues with flights, of which I shared with Robert, but it's nice to meet you all virtually. We really appreciate the opportunity to present to the board today. And just for background, I guess in the interest of time, our remarks are probably about 25, 30 minutes. I know there's a portion for Q&A at the end, but we'll be able to run through our presentation pretty quickly because I know you guys have a long day and a pretty busy agenda, so I want to be sensitive to everybody's time. I'm joined by Ryan Myers, who's a quantitative portfolio manager at Causeway. He's been with the firm since 2013, listed portfolio manager on our international small cap strategy, and obviously an excellent resource into everything that we do, not just investment related to Causeway, but more specifically with our international small cap portfolio. And so everybody should have access to the strategy overview. I thought it would be helpful just to provide some additional context around Causeway before we go through the portfolio construction process. And slide 3 is a good place to start. And so expanding on what you see here, really our core competency lies within global active equity portfolios. And that's been the case since the firm's genesis in 2001. You'll see we're majority employee owned, though I'd point out fully independent. We're owned by 29 existing employees and one former employee who retired from the firm just about 3 years ago. So no outside owners from an organizational standpoint. That's a really important part of our firm and our culture is maintaining that independence, and really been a reason that if you look to some of our clients and consultants who know us really well, that point tends to resonate well with them, having decision makers directly aligned with our own clients. We have 109 employees altogether, of which 39 are on the investment team, and we'll go through the team in more detail. But I want to point out, you'll see 2 different colored fonts here, and that's very deliberate. Our investment team spans 2 investment disciplines. So we have a fundamental capability and a quantitative capability that we blend in varying degrees across everything we do at the firm. We very much believe that these 2 disciplines are complementary skill sets, and they create a really powerful set of risk and reward decision-making tools for our team and ultimately our own clients. Now, specifically with international small cap, the quantitative team, so Ryan and portfolio managers, are taking the lead there as far as building the models, generating the ideas, and constructing the portfolio. But they get meaningful assists from our fundamental colleagues throughout that process. And again, we'll have concrete examples to share there. We manage just about $55 billion in assets under management. You can see the breakdown of our strategies listed below. I think the last thing I would point out, and it's not necessarily listed here, but going back to the firm's inception in 2001, even prior to that, with International Value being launched at a predecessor firm, we have a number of clients who've been with us for over a decade, some close to 3 decades. And there tends to be 3 areas, 3 pillars of our firm that we like to highlight and promote. The first is our employee ownership structure. It's vastly important to everything that we do. It's been incredibly helpful as far as retaining individuals. Our PMs have an average tenure of working with each other of just about 19 years, and we've never lost a PM to a competitor firm, which we're very proud of. The second pillar or point would be, again, that convergence of fundamental and quantitative research. We recognize that one discipline can't go it alone, and that complementary skill set is something that you'll see through any marketing material presentation that we have. It really touches everything we do at the firm. And then lastly, it's a team-based approach. There's no star portfolio manager at Causeway, and that's again by design. We believe everybody should have a backup. Obviously, the metaphorical, if someone were to get hit by a bus and they're the star portfolio manager, that track record leaves with him or her. We don't want that to be the case. We want to provide stability and continuity to our clients. And so we think having a team-based approach allows us to do that. And that team-based approach goes beyond Causeway's 4 walls and headquarters as far as how we partner with plans like yours and with consultants and clients, and that we really want to be good long-term strategic partners and provide your team access and transparency into everything that we do. And so as we go through our remarks today, obviously nothing is off limits, and you'll get a much better understanding of how we construct the portfolio. But we would encourage you guys maybe throughout or towards the end, if there are any questions, areas where we can elaborate a little bit more, fire away and let us know what we can do to be helpful. I'll pause very quickly just to make sure that there are no questions or areas, I guess, Robert, maybe you can take the lead here, that you need us to cover before we go through the portfolio in more detail?
I don't see any questions, and yeah, we'll just stop you if we have a question.
Perfect, and I appreciate you sharing the slide so we can just call out the pages as we go through.
Excellent.
Great. Okay. I'll take over. As Colin said, my name is Ryan Myers. I'm a quantitative portfolio manager overseeing the international small cap strategy at Causeway. I might start on slide 7 to review the team. So this is the entire investment team listed on the bottom half of this slide, and continuing with the color scheme from the previous page, you can see that the quantitative team is on the right side under the orange banner. You can see there are 10 total portfolio managers and analysts on the quant side. We have a lot of academic horsepower on the team, in addition to colleagues that have formerly worked at places like Point 72, Acadian, Arrow Street, AQR as well. But we're supplemented by a roughly 30-person fundamental team, and as you'll see, the fundamental team is very important. As Colin mentioned, we think that each discipline in isolation has some limitations and relative strengths, and so we think combining them makes a lot of sense. Our fundamental team helps us inform model development, model construction. They help us look at new alpha factors, and we also use them as a risk mitigant on the back end. So they review all of our trades, they review our portfolio periodically, looking for any potential red flags, looking for potential quantitative pitfalls. And so they're a very valuable resource that really differentiates us from some of our pure quantitative competitors. With that, why don't I will skip ahead to slide 9 now. And unless there are any questions on team.
Nope, you good.
Okay, perfect. Skipping to the philosophy. So as you probably heard from AQR, there are a lot of reasons why a primarily quantitative approach makes a lot of sense for this particular universe, because this is a very unique universe in the global stock landscape, if you think about it. In our index, which is the ACWI ex-US Small Cap Index, there are over 4,200 stocks. Because they are all small caps, you don't have the concentration issues that we find in, let's say, the S&P 500 or other large cap indices. The largest constituent in this index is only 0.3%, 30 basis points. And so you have this extremely broad, flat index spanning 46 different countries. And so how do you make the trade-offs between all of those stocks, all of those sectors, all of those countries on a very real-time basis? Well, a quant approach is very good at that. It's sort of objectively, efficiently sorting through that universe on a daily basis and ranking that universe from most attractive to least attractive. The other nice thing about a quantitative approach is we can combine multiple sources of alpha signals. And so we are value investors at heart. Value plays a key role in our model in stock selection. But we can also combine value metrics with measures of sentiment, technical measures, quality measures. Quality is very important given the higher failure rate among small caps, corporate events, and then we're also able to blend in top-down measures as well to, again, help make those trade-offs. And we can very efficiently sort of reach down the market cap spectrum, something that's difficult for a purely fundamental approach to do, to get in some really sort of undiscovered gems that are in the sort of couple $100 million market cap size range. Finally, a big advantage of quant is in risk control. We have our own risk models in-house that we use to manage this strategy. But as I said, we really view our fundamental colleagues as an extra layer of risk control, given some of the idiosyncrasies, given some of the fact that, again, you can't quantify everything in the world, and they're very helpful as an extra layer of risk control. So with that, I might just jump straight into the process on slide number 11, 2 slides ahead. And I'll sort of briefly describe the investment process, the alpha model that sort of underpins most of the stock selection for this strategy. As I said, we start off with the entire universe of stocks in our index, the ACWI ex-US Small Cap Index. We do an initial screen for liquidity to weed out stocks with less than $1 million in average daily trading volume. And that really just gets rid of the very small microcap, sort of less liquid part of the universe. We're still left with about 3,300 stocks that we can then do a full analysis, full ranking on. We compute what we call a final alpha score, which is, you can think of it as an expected return for every stock in the universe. 90% of that final alpha score comes from bottom-up company-specific metrics. The remaining 10% come from 2 country-level top-down models. Within the stock-specific categories, you'll see 5 main categories listed there. The first being valuation. So valuation, again, receives the largest weight on average. When we design these value models, we have separate valuation models for every sector. Our fundamental team helped us design those models to really focus on the most relevant value metrics for every sector. When we think of valuation, we think of it on a country neutral and sector neutral basis, because of course across such a broad universe there are certain sectors, certain countries that perpetually trade at premia or discounts, and so we want to find cheap companies relative to their country peers, relative to their sector peers. So the next category is sentiment, and here what we're looking for is companies with improving sentiment, where the estimates from the sell side are actively improving. We want to find stocks being actively upgraded, where there's sort of positive and building sentiment for these stocks. Third is technical. So technical is essentially refers to momentum. We do a lot of risk adjustments to the momentum scores to make sure we're not just creating a very high beta portfolio. But in addition to analyzing the focal company's momentum, we look at what we call network momentum. And network momentum is really referring to the broader ecosystem in which a company operates. So we're looking at the momentum of a company's suppliers, customers, competitors. We use certain natural language processing tools here to identify peers, even if they may operate in a different sector. But ultimately, what we find for small caps especially is that there's a large to small information transmission mechanism. So if you take, think of a giant company like Apple. If Apple reports very strong iPhone sales, it may take a day or two for that positive information to filter down into some of Apple's smaller cap hardware suppliers. And so having that, the momentum of sort of, in that case, the ultimate customer embedded in the alpha score provides a very tangential but uncorrelated signal to the underlying company's momentum. Next is quality. So quality, again, is very important for small caps, given the higher failure rate, given the more, a lot of these companies tend to be focused on one business line. They don't have the diversity that a larger cap company does. And so we look at quality both on a traditional financial strength basis, as well as what we call competitive strength. So financial strength refers to obviously sort of cash conversion, cash efficiency, leverage, things like that. Whereas competitive strength is really trying to identify the small caps with the pricing power, with the business models to succeed longer term. And so in that category, we're looking at long-term trends in margins, in returns, in market share. We also examine the industry structure in which a company operates in to, again, hopefully identify the small caps that will eventually succeed and become large caps. Finally, the fifth category under stock specific is corporate events. And this here we're tracking over 30 different individual corporate events. So think management changes, debt offerings, equity offerings, dividend changes, share buybacks, things like that. And we're looking at this sort of typical reaction to these different types of corporate events. So turning to the top down, which again, the top down is 10% of the final.
Ryan?
Oh yeah, please.
When you say technical and momentum, are you, and I'm going to maybe crudely state this, or imperfectly stating this, are you saying charting? Is that what it would be, partially the technical analyst type of versus quantitative?
That term does refer to charting, but in this, or in a traditional sense, but in this case, I'm only referring to the momentum of the underlying stock. So we look at momentum on a 3-month, 6-month, 9 months, 12-month basis. And the general idea is that past winners, past stocks that have outperformed generally continue to, and similarly, past losers tend to continue losing. Now, as I said, we do a lot of adjustments. We back out a near-term period for reversal. We do a lot of beta adjusting, risk adjusting. But the simple idea is that, yeah, again, past winners tend to continue winning, past losers tend to continue losing. When you refer to charting, that usually involves a lot more other techniques, looking for patterns in historical returns and things like that. Here we're taking more of a direct momentum signal.
Thank you.
Yeah. So turning to the top-down characteristics we're looking for, again, this is to help make the trade-offs between the 46 different countries we're dealing with. So first, from a macro perspective, we're looking at things like purchasing manager indices, other leading economic indicators. We're looking for current account deficits. We have a political risk score in there. Also, we're looking at trade-weighted foreign exchange. And the idea here is to sort of tilt the portfolio toward countries with better macroeconomic backdrops. And then finally, country aggregate. So here we're basically aggregating up a lot of the bottom-up characteristics within a country. So from a valuation, from a momentum, from a growth perspective, and trying to find the more attractive opportunity sets. How attractive is the opportunity set in one country relative to another country at a point in time? We're then able to basically roll all of this into one final assessment of every stock, which, as I said, is used to, on a daily basis, we can rank the entire universe from most attractive to least attractive stock. We then supplement that alpha score with what we call a risk score. Again, we want to be conscious about how we construct the portfolio. Your typical international small cap stock, the median volatility over the last 20 years was 39%. So it's very high for individual stock. And so portfolio construction matters a lot, how you try to diversify the risks and ultimately come up with a portfolio that resembles, a large cap index volatility, sort of in the high teens as opposed to the high 30s. And our risk model essentially looks for diversifying trades. It looks for every stock's exposure to over 100 different individual risk factors. It looks at the historical volatility of those risk factors. And then it also, as I said, it prefers exposures to lower volatility risk factors and diversifying risk factors. So if we're, let's say, overweight energy, it will look at that marginal energy company and say, okay, you're only giving me more risks that I already have. I'm going to give you a higher risk penalty. And then so you can think of it almost as an expected Sharpe ratio, sort of return per unit of risk. We're trying to maximize return and minimize the risk in the portfolio. We have certain portfolio level constraints, which you can see in the middle of the page here. Country or sector plus or minus 5%. So if a country, let's say India, is about 7% in the index, we'll hold between 2 and 12% of the portfolio in India. Currency, we widen that bound to plus or minus 10%, mostly to allow for the Eurozone, which includes multiple countries in this universe. And at the stock level, plus or minus 2%. As I said, the largest single stock in the index is only 30 basis points. So this is in effect just a cap on individual stock exposure. Currently, that would be, the largest position we could have would be around 2.3%. We have a model also that incorporates trading costs, market impact, to sort of minimize positions in less liquid stocks, in less liquid parts of the universe, near to be about 5% versus the index. And last but not least, as I mentioned before, we have our fundamental team that analyzes the portfolio really on 2 primary occasions. So first, when we do a rebalance trade, we send all of the new buys to our fundamental team and ask them, again, is there anything we're missing here? Things like regulatory litigation changes, potential mergers and acquisitions, instances like that. We also have a standing monthly meeting where we will go through the entire portfolio and focus on the biggest detractors over the last 3 months. And again, ask them, is there anything we're missing here? More often than not, they simply confirm the thesis, the relative attractiveness of the stocks we're buying. However, 2 to 3 times a quarter, I would say, they will bring up a potential negative that may change our view, and we can trim that position back. We can eliminate it from the trade list entirely. I'll give you a couple examples just over the last year of where we've intervened and sold a position based on their feedback. About a year ago, we held a Japanese pharmaceutical company that was developing a treatment for a specific type of muscular dystrophy. Our healthcare analyst alerted us to the fact that they had a very large US competitor that was about to get FDA approval for a competitor treatment. And based on that feedback, we sold the stock. Indeed, the competitor did get approval, and the Japanese stock declined, and we were able to avoid that. In another situation, last summer, we had a Swedish steel company that was in our portfolio. Our materials analysts alerted us to a guidance or CapEx announcement that this company made, where they were converting one of their major steel plants into producing what's called green steel. So it's producing steel with no carbon emissions. The downside to that plan is it was going to result in negative free cash flow for that company for the next 4 or 5 years. And unfortunately, the final product is the same, whether it's produced with or without carbon emissions. And so it was going to sort of drastically change the financials of this company. Again, we were able to sell out of that position before a subsequent stock decline. Finally, another example just from this January, we held a Korean insurance company, mostly property and casualty insurance. And our financials analysts alerted us to the fact that this particular company had some major capital concerns. They were really pinched from a capital perspective, and that would likely mean a significant cut to their dividend. And that was actually a new position which our model wanted to buy, which we ultimately held out of the portfolio. And again, the company did indeed cut its dividend and the stock declined. So those are some examples of how our fundamental team can really inform the portfolio construction and really try to avoid the pitfalls, potential pitfalls of a purely quantitative process. Again, it only happens maybe 2 to 3 times a quarter. In most cases, they simply reaffirm the attractiveness of the stock. And so that essentially brings us to the final portfolio of about 120 to 200 stocks. So this is definitely more concentrated than some of our purely quantitative competitors, and that's by virtue of the fact that we do have 30 fundamental colleagues that help us sort of, again, avoid the pitfalls. But let me pause there and see if there are any questions on process overall.
None noted.
Okay, great. Maybe I'll move on to the next slide and just show you what kind of portfolio this actually produces, the net result of this process. Here, you can see on the bottom of the slide, we currently have 177 positions in the portfolio. Weighted average market cap very similar to our index, just slightly larger. I would note that we don't immediately kick out of stock if it graduates. That's ultimately the goal here, is to find stocks that are going to be large caps. And so we don't immediately kick out a stock in our portfolio just because it graduates to the large cap index. We'll let the alpha assessment by itself decline to a point where it naturally gets sold. But you'll see the characteristics of here really, we're often finding companies that sort of tick every single box of attractiveness. We can find cheap companies. Here you can see the price to earnings ratio. It's cheaper than the index. For reference, we also show the value and growth versions of the index, and you'll see that this portfolio is actually cheaper on a PE basis than the value version of the index. You could see dividend yield better, it's higher than our index, and also in line with the value index. And yet you can also see from an ROE, return on equity, so this is a quality measure, you can see that this number is higher than the index, but also higher than both the value and growth versions of the index. You can see that there's more embedded momentum here than both the value and growth indices. And then from a revisions perspective, so this is looking for the sell side assessment estimates of a stock. Again, we're looking for stocks that are being actively upgraded. This is a measure over the last 3 months, and you can see at plus 15%, we hold a portfolio that is being actively upgraded. And that compares to pretty close to zero for the actually slightly negative for all of these other indices.
Hey, Ryan. Quick question. In terms of the benchmark that you use, it's the ACWX small cap. It's not the value tilted in, right? Okay.
You're right. It's the second column here, the ACWI US small cap index. We just provide the value and growth versions for reference. And the point being, this is such a large universe full of, a lot of inefficiency that, unlike the large cap where you sort of have to pick a style, if you're picking value companies, you're sort of giving up growth characteristics. I would argue that in this universe, you can assemble a portfolio that is very cheap, that is still outgrowing the index, that has more momentum, upward revisions. You can sort of form a portfolio that in many cases, again, you're finding companies that tick every single box of what you would look for in the ideal investment candidate.
Thank you.
Yeah. So yeah, maybe turning to performance. I know there are a lot of numbers here. I just focus on the second line and the fourth line. So comparing our net returns to the index, to our benchmark's net returns. And you can see overall trailing periods, these are positive. Through yesterday, we're up about 180 basis points year to date. And you can see overall the trailing periods, the alpha production is positive. I can talk about some of the drivers of that. Again, this book is just basically a year-to-date book, so it's a little short, so I'll be brief on some of the attribution comments. But starting on slide 15, you can see the returns to each of our factor categories. So we talked about the 5 bottom-up and 2 top-down categories. Importantly, they've all been positive year-to-date, and that generally turns into positive returns. The macro and country look especially large here because the way we define these returns, those can be a little chunkier. We're basically sorting the universe by one factor category, taking the top 20% of stocks ranked by that category, the return of that top 20%, and subtracting the return of the bottom 20%. So in the case of the top-down categories, those can bring in entire countries, which again tend to be chunkier and produce chunkier returns. But keep in mind that 90% of the final alpha assessment comes from those bottom-up categories. So even though the returns look a little smaller, the weight is a lot higher, and so they do have quite a bit of impact. But again, the important part is all of the factors that we're looking for in the ideal stock here have been positive returns to those factors year to date. If we go through the next slide, the regional attribution, this is sort of a typical Brinson attribution. So it breaks alpha generation down into country allocation decisions, those are in orange, currency in green, and stock selection in blue. If you look at the bar on the far right, you'll see that the majority of the alpha comes from stock selection, and that is very typical over longer periods of time. You'll actually see a much smaller contribution from these allocation decisions. We want most of the alpha coming from the underlying stock selection. Year to date, I would just point out that the orange bar consists of, the country allocation consists of our overweight to Korea, which is outperformed, and also an underweight to India, which is underperformed. And maybe I'll turn to the next slide to look at the sector attribution. Just to, again, this is only 2 months, so I don't want to spend too much time on this, but we've have had some great success in a few sectors, a few companies specifically. Within industrials, we own a company called Hanwha Vision in Korea. Historically, they're more of a video surveillance company. They've gotten into high bandwidth memory semiconductor supply. They just won a huge contract with SK Hynix, one of the large semiconductor manufacturers, and so that stock is up over 50%. Another industrial out of Europe, Iveco Group, they own a defense business, which they're selling, and given the heightened focus on increasing defense spending in Europe, that business is expected to sell for quite a premium now. So that stock is up over 60%. Turning to financials, we have a variety of financials contributing to relative returns, including a Chinese company called Finvolution, which does direct to consumer lending. They're seeing accelerating loan growth, especially with the stimulus expected in China. That company's done quite well. It actually just announced earnings yesterday and was up about 18% just yesterday alone. Another Italian insurance company called Unipol, which is seeing very strong results as well. They just upped their dividend. And finally, an Austrian bank, Raiffeisen, very successful results out of Europe. They also own a small Russian business, which is expected to, which they've been trying to sell for the last few years, obviously since the invasion. But now with the Russian-Ukraine expect fire on the horizon, that the overall valuation has improved for that company overall. Why don't I just pause there and see if there are any. I'm happy also to address longer term 2024 results, alpha generation, if that's of interest.
Questions?
Okay. I guess I know we only have a limited amount of time here, but one slide I did want to hit on was slide 33, which is just stepping back and looking at our longer term track record. So we passed our 10-year anniversary in November of last year. And what we do is, again, the point here is by diversifying the types of factors we're looking for, we really want to create an all-weather return stream that can perform, that can generate alpha, regardless of sort of the macroeconomic backdrop, regardless of which style happens to be in favor at a particular point in time. And so if you just focus on this top left box, what we show here is we take the last 10 years and we sort of slice it into smaller sub-periods. Periods where, let's say, value as a style is outperforming, periods where value is underperforming, periods where growth is doing really well, periods where it's not doing well, and so on down the line. We look at large cap versus small cap, high momentum periods versus low momentum or reversal periods, periods in which the yield curve is steepening or flattening, periods which the US dollar is strengthening or weakening. And then we report our batting average in each of those sub-periods. So batting average is the percentage of months that we're generating positive alpha. Now, obviously, we want that to be 100% ideally, but in practice, we're shooting for really anything over 50%. We want to be right more often than we're wrong. And you can see in this case, in all of those different style regimes, we're able to produce positive alpha. And we compare ourselves, just for the record, to the three largest diversified international small cap managers as portfolio B, C, and D. And the point is not to sort of pick on anyone. The point is to show that a lot of our competitors are more reliant on certain specific styles to produce returns. You can see that in a lot of those cases, you'll see numbers below 50%, which indicate more of a reliance on a particular factor. In many cases, what we find is that people think of small cap as synonymous with growth. And so you'll see some of our competitors underperforming when value is in favor or when growth is out of favor. Again, we think that you can combine all these characteristics and produce a much smoother return stream where you're not forced to make the trade-offs between these different style orientations. So I'm happy to quickly address current positioning as well. So if we back up to slide number 18, you can see our current active weights by country. And so if you just look at that, you'll see our portfolio weight, you'll see the index weight, and then what we call the active weight, which is relative to the index. Are we overweight or underweight? Once again, you'll remember we do have a plus or minus 5% constraint on that. But currently, our largest overweights are to Italy. Italy's very attractive from a earnings revisions, from a momentum perspective currently. Japan as well. We're finding some very attractive valuation opportunities in Japan right now. And there's really been an effort within Japan to improve shareholder returns, to improve corporate governance. And so that's helped with the overall attractiveness. Finally, Taiwan on the right side of the page. It's our number 2 overweight currently. Our macroeconomic model definitely prefers Taiwan. It's one of the few countries out there with a current account surplus currently. So very attractive from a top-down as well as a bottom-up opportunity set. Where we're underweight is mostly parts of Europe. So Sweden, you'll see our largest underweight, mostly due to expensive valuation overall and negative momentum. Also the UK for momentum purposes, also just we're not finding a lot of attractive bottom-up opportunities. And then finally, France is the number 3 underweight currently. So any questions on current positioning?
Not seeing any.
Okay. So I'm happy to, why don't I just pause here? I know we're sort of coming up on the 45-minute mark total. I just want to save plenty of time for any lingering questions about any part of the process, our portfolio, any questions overall?
Yes. What is your rate of turnover for stocks?
So turnover was intentionally designed to be under 100%. So you'll usually see it in call it the mid-90s. We want most of our returns to be long-term in nature. It was a little elevated last year simply due to the fact that we had a lot of inflows into the mutual fund. And so we had to put that money to work. But we intentionally designed the strategy to be under 100%.
I had a question about the research and the research team. I know you mentioned, you're working with the fundamental folks. I'm curious about, their level of interaction with management of these companies and, sort of travel. I mean, how active are they?
Yeah, they're very active. It's a great question. And even though most of their direct coverage tends to be larger caps, they frequently meet with management teams of the companies that we own. And I would note that where it's convenient, the quantitative PMs may also sit in on those meetings or take the meetings separately. But it's interesting. They usually have a lot of feedback on our trade list, on our portfolio, based on direct interaction with the management teams. And so they can really offer insight. And they can also offer a more broad perspective, is because as I said, a lot of their direct coverage is the larger cap competitors. And so just knowing the entire competitive landscape really well is a major asset.
I guess another question that sort of pops up in my mind on the laggards in the portfolio, can you talk about that process of reevaluation?
Yeah, so as you can see, as I hopefully explained, the process of ranking the universe is really a continuous process, right? So from one day to the next, there may be a different assessment of the same stock. And there's some countervailing signals that go into our model. So on one hand, if a stock is declining, that usually means the valuation is going to look more attractive. Countering that, though, is the fact that we have momentum in the model, which is naturally more trend following. And so that's going to look worse if a stock declines, again, holding everything else equal. So it's really sort of a constant battle. These stocks really have to fight for a spot in the portfolio on a continual basis, because let's take the ideal situation. If a stock is attractive, it may it may come into the portfolio at a low weight due to one characteristic being attractive. Usually, as I said, it's usually a few, but it will generally come in at a low weight. It will work its way up as some of those metrics get more attractive. But at the end of the day, valuation is the largest component of our model. So if we're right about a stock that we buy, over time, its value score will naturally decline. It will look more expensive over time. And that will force its ranking down relative to the universe. We will likely reduce the weight over time as that happens. And ultimately, it will be completely replaced by a stock with much more attractive upside opportunity. But it's really hardwired into the process, as you can imagine.
Any further questions? I would like to ask a question that was asked by one of our trustees who has left to the other two presenters, and that would have to do with tariffs and how the impact of tariffs might be impacting your portfolio.
Yeah, well, the first general comment I would make is that small caps are much less exposed to tariffs than large caps because they're much more domestically focused. If you look at the index overall, our benchmark, the ACWI ex-US Small Cap Index, 66% of the revenue of the index overall comes from the respective domestic market, so the home market of every company, 2/3 of the revenue. If you look at the equivalent large cap index, the ACWI ex-US, it's 48%, so much more. Those large caps are much more reliant on global trade overall as a source of revenue, and therefore are much more susceptible to tariffs in general. I'd say, we've spent a lot of time sort of analyzing country by country. The nice thing is that individual companies that have been focused on in recent headlines are relatively small in our portfolio. So China is only 3% of the index here. Mexico's under 1%. Canada is a little larger, but most of our exposure within Canada is to, at least currently, We own an asset manager, which is very domestically focused. We own a few oil resource companies that, again, are subject to lower tariffs, and they do enjoy a cost benefit in the natural resource extraction versus some of the U.S. competitors. So even with a 10% tariff, they'll be competitive. But it's something we've spent quite a lot of time speaking with our fundamental colleagues about. We're pretty confident that a lot of the exposures we currently have are much more domestically focused on the home market, and therefore wouldn't be as susceptible to global tariffs, to U.S. tariffs specifically. Yes,
Trustee.
How big how many issues are there in your potential buy list, and how much turnover is there in that potential buy list?
So the typical rebalance schedule, again, we run sort of optimal optimizations daily, and so we can constantly compare the current portfolio to the optimal portfolio. Usually about once a month, that difference will diverge significantly enough where we'll do a rebalance trade. But in more volatile markets, it can be several times a month. So typically, again, we're targeting under 100% annual turnover. So usually that means about, call it 8%, 7 to 8% monthly turnover. Usually half of that turnover is spent adding to existing positions, trimming existing positions, and the other half is full, like new buys, new stocks entering the portfolio, and or full sells. Does that answer your question?
Not quite. I was wondering just how big your potential new buy list is, and how often does that change, or how much does it change?
So the brand new buys will usually, again, we're dealing with about currently 175 stocks in the portfolio. So a rebalance, might look like 40 or 50 total trades, maybe 10 full buys, new buys, 10 full sells, and the rest are sort of trimming around the edges. But again, we look at the entire universe on really a daily basis. So all 4,200 stocks are theoretically eligible for inclusion in the portfolio.
Thank you.
I have a question. I guess it's not necessarily about the strategy, but on page 36, the weighted average market cap of the benchmark sort of skyrockets at year end there. So I sort of wondered,
What'd you say?
I'm assuming that's, a small handful of companies, maybe one company. I don't know. Page 36.
Yeah, I see that. I see what you're talking about.
Yeah.
I would have to double check. That looks like a spurious data point, if I were to be honest. That's for the index as a whole, right?
Yeah.
The overall index. But if we compare that to what's on the characteristics slide, on slide 12, that would indicate that it should be around 2.1 billion. And so we'll have to double check that. I appreciate your sharp eye. That looks wrong to me, but again, that's just for the index overall. Because I know there weren't any. So MSCI rebalances at the end of May and the end of November. So I don't recall any in the November rebalance there being any large things. Usually the way they construct the index is just taking the bottom 15% of the broader international universe by market cap. And so there shouldn't be
I mean, so for trustees, I see that and I'm going, oh, I wonder what that portends potentially in the future.
That would be concerning.
Any other slides?
Any other questions from trustees? Questions from Callan?
Great.
Okay. Thank you very much for your presentation.
Thank you. We appreciate the time. If there's any other questions as you guys go through everything, please let us know. But I know I'm standing in the way between you guys stretching your legs. So appreciate the time and hopefully we get to continue the conversation at a later date.
Thank you very much. Thank you, Ryan. Thank you, Colin.
Take care, everybody.
Colin, I'll be in touch with you, of course.
Great. Thank you. Take care.
Thank you.
Okay, do we have any board discussion on the Causeway presentation? Any notes, any comments? Not seeing any, so is there any public comment?
No, there does not appear to be any.
No public comment. Okay. So at this point, I think we should take at least a brief break. How about if we come back at 12:20? That'd be about an 8-minute break, and then we'll have Callan do the wrap up. Okay.
Okay.
I guess you're using your .gov, aren't you, at this point?
Yeah. Is it, I don't know. Okay.
It won't hurt, it'll always work.
Till the county changes it again.
Don't get me started.
No, it's a state mandate.
There was, but there wouldn't have been if we'd have stuck with co.mendocino.ca.us, which is easier to type and has fewer characters in it. There, I said it. Which would have stopped all of that. Anyway, I guess we're ready to resume. If Scott is ready to get us going again.
Yeah, we're ready.
We are
Maybe pull up
on
Callan's. No, not that one. Callan's one. Callan's dot.
item
Sorry.
4.
Thanks.
E. Small cap manager selection discussion. Oh no, I'm sorry.
That's correct.
Oh, discussion by Callan. Correct. Okay.
Yeah.
Closing comments from Callan, Greg, and Claire.
Great. Well, we won't recap everything, but I think we have a good decision to make today. From our perspective, we really like all three of these firms. We think all three strategies, as I mentioned earlier, would be good complements in your portfolio to T. Rowe Price. We really don't think there's a bad choice to be made today. So that's a good thing. It does make the decision potentially harder though. So just to recap, we've got AQR, Brandis, and Causeway. Brandis is who we heard from first. They're the fundamental strategy on the list here. And then Causeway and AQR, both quantitatively driven portfolios. Causeway, as you heard in the last presentation, does have a bit of a fundamental lens to their quantitative process as well. I did note the fees earlier, so we'll put those back in front of you as well. Fees are important, as I mentioned earlier. Within the context of the total international portfolio, though, and also specific to this international small cap mandate, we think these are all reasonable. And when we look at how the managers have delivered on their strategies, they've all achieved excess returns net of fees. But Brandis is 75 basis points is the proposed fee for the vehicle, AQR at 95 all in, and then Causeway at 110.
Just for trustees' knowledge, it's about $30,000 difference between all three.
Thanks, Robert.
A year?
Yeah.
And as I mentioned earlier on kind of that pro forma fee look that we put together, it comes out to a difference of about 2 basis points at the total portfolio level. Going back to slide 6 here in this deck, again, just to, let's see, one more slide forward, just to kind of recap how these managers sit from a style perspective. Again, Brandis is going to be the deepest value. I believe it was Trustee Swope that also pointed out that, a bit more of a micro cap kind of overall posture to the strategy. So a bit smaller in cap size. Causeway and AQR, a little more what we would call relative value. So I think, I heard Brandis kind of characterize themselves more as, we are a value manager. Causeway and AQR are talking more about valuation and do consistently have value orientation to the strategy, but a little bit more core value overall. Again, we think all three would be good complements to T. Rowe. Now that we've heard from the managers, going one slide forward to look at performance again, all three managers have delivered on performance. Absolutely great return track records over all the time periods measured here. These are gross of fee returns. I think the managers did point to net of fee returns in their presentation. And if you look one more slide ahead at the calendar year returns, I mentioned this earlier, but I think these numbers give a good sense of kind of what the path to get to those longer term 10-year returns has been like. Brandis, deeper value manager, higher tracking error versus the core peer group and benchmark. Again, just to note, that's what we expect. But when we looked at that 10-year return, you know, they've ultimately delivered very well. I think they have the highest net return of the three managers over that 10-year time period. Just might experience more bottom quartile performance, more top quartile performance. The two numbers that jump off the page here, or the two time periods that jump off the page here for me, are 2023. You know, Brandis was up 40%, right? An incredible return. The other two managers up 20 and 29, also quite notable. But that countered in, in 2018. You know, where they turned in more bottom quartile performance. So just, you know, expecting that in the path to get there. And I think that comes through also in the next page when we look at rolling 3-year returns. So these charts we looked at once before, but what for each chart represents one of the managers. So T. Rowe Price, who we're complimenting, is in the bottom right-hand corner. And then the three candidate managers are the top two charts, and then the bottom left. The gray distribution on each of these charts represents a peer group of international small cap managers. The white line in the middle of that gray distribution is the median of the manager. And here we're looking at rolling 3-year excess returns. So returns for each manager in excess of the ACWI ex-US small cap index. So each point on one of the colored lines that lands above the 0 line is a point where the 3-year rolling return for that strategy outperformed the benchmark. And, you know, of course, the opposite true. If it's under the 0 line, it's a 3-year point in time where the strategy underperformed the benchmark. So I think this just gives a good visual, again, of the rolling 3-year performance history for each manager. And we can compare that to T. Rowe Price in the bottom right corner of the page. Brandis having bigger swings. Again, we expect that because of their deeper value orientation. I'll point to page 13 quickly. You know, this just looks at excess correlation, excess return correlation. Sorry, I'm one page off. So page 14 of the PDF. Excess return correlation. I focus on the bottom line here. This is showing us that there is, you know, negative excess return correlation for each of these three managers with T. Rowe, who we're looking to complement. I wouldn't put too much emphasis on the difference between these numbers. The fact that they're all negative, again, emphasizes the fact that they should all be good complements to the T. Rowe performance pattern. And then lastly, the last two slides here, one slide ahead, we plot risk versus return.
Is that just the next slide?
Yeah.
Yep.
There we go. Yep, exactly.
Sorry.
Perfect. And you know, just what we want to see from all three of these managers, but the crosshairs here represent the median of the peer group for each characteristic. So standard deviation or volatility on the horizontal axis, returns on the vertical axis. Brandis, Causeway, and AQR each delivering returns in excess of the benchmark, in excess of the peer group median, with lower volatility than the peer group median, and kind of volatility pretty similar to the ACWI ex-US small cap index. And then page 15 just looks at similar metrics, but relative to the benchmark. So here we're looking at excess return versus tracking error. All of these managers have delivered excess return. Brandis has the highest tracking error. Again, that's what we should expect from the strategy, given that it's a deeper value strategy compared to the other two when we're looking at this core benchmark, core peer group. I'll pause there.
Okay. Do you want opinions or?
Yeah.
Well,
Make sure your mic's on.
Okay. My opinion is, you know, Brandis has the best results, the best returns compared to the others. It's the lowest fee. It complements T. Rowe Price the best. And, you know, there's a couple things I don't like about it. I don't like that it's focused on defense and aerospace. And you know, looking at their limited partners, it's almost all male. But, you know, as far as the results, it's and what we get out of it, it seems like, you know, less volatility actually, and so seems like that would be the choice.
Yes.
I'm leaning to two. I mean, two of them, but I want to hear other people's opinion. I like AQR and Brandis, and probably depending on what points other people have, I would probably shift to decide on the one.
What sort of things stand out to you about either one of those? Let's
Well,
say
I just
AQR.
like a lot of their methodologies. I mean, that's very disciplined, very logical, and the results seem to then track as a result of their strategies.
Trustee Kelly?
Turn that on, yes, I agree with the methodological basis as opposed to the word like or don't like. That's the nice thing about a pure quant is that it's just looking at numbers. And if the best opportunities are in a particular sector, go for it, regardless of what the world thinks about that sector.
Trustee Kavnis?
I just want to on that there. Okay, so I prefer AQR for a similar reason, the way that they reach their, I like them.
Personally, I agree that I liked Brandis, but I also liked AQR, but I was a little concerned with the amount of turn on theirs and how many they're invested in it. But they did seem a little bit more conservative in some regard. And it really depends on which direction you're looking. If you're looking to be more conservative and strict only to their analytics as opposed to, because they really kind of didn't seem to have much deviation from their analytics. And so that's a plus and a minus to me. Like, I think you can be stuck in just being formula driven without really understanding your market.
So I would ask staff, Robert, what is your opinion?
Well, so I look at this from the total international allocation, right? We're restructuring the whole thing. So what I reviewed is the new structure with the new index, with the new manager artisan, and I looked at the total portfolio allocation, looking at each one of these individual managers. What if we add AQR? What does this stream look like? What's the expectation with them? Looking at Causeway, the same thing. Looking at Brandis. So I look at all those different total portfolios. And so one of the things that I prefer and that I think is important for the whole portfolio there is essentially the lowest risk we can get for the highest return, right? The highest return for the lowest risk is how I think of that whole allocation. And when I reviewed the numbers, what I found sort of surprised me. AQR and Brandis are actually more risky in the whole context of the total portfolio than Causeway is. Causeway has a differentiated enough return stream that the market exposure, the market beta, the market risk of the total portfolio drops below 1. So we're talking 0.96 or 0.97, depending on what benchmark you want to look at it. So I have a preference for that. I have a preference for low beta, lower than 1. AQR and Brandis, actually, when you combine them into the total portfolio, they're nearly the exact same total performance to 2 decimal places. It's the same thing in terms of the total performance. Betas over 1, higher standard deviations for whatever period, whatever asset benchmark. You can look at the asset class benchmark. You can look at the strategic sum of the benchmarks per the managers. And so because of those reasons, I have a preference to Causeway. That's my take on it.
Okay, so there was a couple of things about Brandis's presentation that I really liked. First of all, I did notice that they were the lowest fee, and they did have the highest return, and I'm using the 7-year, I call it the 7-year because there was a slide that was presented that had, for all three, and it was 1065 versus 7.87 for AQR versus 9.64, all very good. What Brandis did in their presentation that I really appreciated was they actually compared their juxtaposition T. Rowe Price with their own investment structure. So, and they made a good case that they would complement that particular aspect of our portfolio, not doing what you did in that looking at the risk for the entire portfolio. I came into this with a gold star by AQR, or a blue star, because in my initial investigation, I thought they looked like the most solid company in terms of, of what you were talking about. They looked like they had a lower risk in the downside. But Brandis had a better presentation for me, and I do like the fact that they've had the best average returns and that they have the lowest fees. So those were my thoughts on it. And
one other thing that I would point out is, right, coming out of the pandemic, there's been a massive value rally. So I do want to, yes, Brandis has great returns, but you sort of have to factor into your own thinking that this massive value rally post pandemic has really contributed significantly to those higher 10-year returns, right? If you look at the 10-year graph or table, and those numbers are really pumped up because of what has happened with this value rally.
Sure, and I appreciate that.
Not to say that it's not good, because they still are really good. Even going back to 1995, they still have very strong performance.
Now, all three have fairly large slants towards value, which T. Rowe does not have.
Yeah.
Right.
That's the point. That that they would move together, complementary. Right. One's up, one's down. That's better for the small cap allocation as a whole.
Yeah. But it doesn't necessarily distinguish one from the other. The three candidates from the other in terms of being value oriented. Doris, did you have a comment?
I was just going to mention that in the Callan's presentation on slide number 9, I guess it's actually 10 because the cover page, that there you can see the difference between the three value managers and how they complement T. Rowe Price, which is in the growth aspect. When you compare their colored lines to the colored lines of line for T. Rowe Price, you can see the impact of value and where it has outperformed sometimes compared to the growth market. I was just going to...
In the item 3E, the document that combines the staff memo from December, you can also see some of that correlation, if you were curious, at least for that time period, between each one of the managers and T. Rowe.
I want to catch up on the slide that we're looking at here.
Yeah, let's get it up here.
10 on which...
So which...
Well, my comment was about specific correlations for the three managers with T. Rowe, which in the case of AQR is a 0.9.
Okay, yeah.
No, Robert put
Yeah.
together some information that was sent out. It's attached.
this?
The 0.9 AQR correlation with T-row, 0.90 AQR.
Gotcha. Right here.
And you can go to the next page and look at Brandis, a 0.82.
Okay.
And you can go to Causeway and look at Causeway of a 0.86.
Okay. Yeah.
So, is there any other discussion that we'd like to have? I feel like there is more to be talked about here. I don't feel a large consensus really developing. But if there is no further comment, we will first ask for public comment.
There is no public comment.
Hold on, I believe we have another comment.
I said that I, prefer AQR the best, but I would also be happy with Brandis. Just want to add that.
So we're looking for a motion and a second. There certainly can be more board discussion, but
Is there anybody who would like to make a motion?
I'll make a motion. I'll make a motion to select Brandis as the International Small Cap Manager.
Do we have a second?
Second?
Okay, let's have some more board discussion on the selection, potential selection of Brandeis. I'll start with, I don't see a lot of daylight between Brandeis and AQR. I had Causeway almost completely off the radar until Robert brought it in.
Really, just after Robert's comments, it really looks like Causeway is less like Brandis and AQR. They aren't totally comparable in that category. So we've got, two Brandis and AQR and Causeway are enough different that, to me, that they don't fit in this. So, yeah, since we have had less positive comments about Causeway, we're really looking at the difference between Brandis and AQR. And there isn't much difference there other than what I saw. Trying to remember, Brandis has apparently greater volatility. They do better than the others in some periods, and less bad from the others in some periods. But significant swings, and in my business, I don't mind that. But again, thinking about what this board has said in the past, this board seems to like stability more than excitement. So, but yeah, if it were me, I think the coin flip would come up about 55-45 for Brandis. I could go with both, but my own gut feeling would be to go with Brandis.
As I said before, I'm comfortable with either AQR or Brandis, and certainly if most of the board is comfortable with Brandis, I'll go with Brandis.
Okay, if there's no further discussion, I guess we would just move on to a roll call vote here.
For public comment?
Oh, public comment. Is there any public comment?
There does not appear to be.
Okay.
And so the vote is for Brandis.
Well, we will have the vote. That's the motion, yes.
Okay. Mr. Kelly?
Aye.
Ms. Cavanis?
Aye.
Mr. Haschak?
Aye.
Mr. Swope?
Aye.
Ms. Covison?
Aye.
And Mr. Land?
Aye.
Approved.
Okay. That brings us to item 4F. Preliminary monthly investment performance report, Robert Ravelis.
Trustees, you have the preliminary monthly investment report. I'd be happy to answer any questions. I guess let me point out one thing. Last year there was some discussion about whether or not we should be diversified in international markets, and really since the beginning of the year, even through yesterday, sort of has shown that things can change relatively quickly, and sentiment shifts, and now we can see that international, at least in these shorter periods here, has sort of rallied back.
That was just a lucky guess.
Yeah. I don't think anybody, I want to meet the macro strategist, right, that thought that Trump was going to do what he's done, but I think that's the catalyst for what's going on.
I'm sorry, I may have brought up the wrong item here, but it looks like I did bring up the wrong item. We actually did fairly well last month relative to what I was expecting. Do you have any comments on that?
No, it's sort of turned back around this month. I mean, through yesterday.
Right. Yeah, that was kind of what I was dovetailing into there. I don't want to predict what we're going to be seeing, but I would make a prediction that it won't be as happy next month as it is this month, even though I believe we were $1 million negative this month.
Yeah, I mean, we're back down to somewhere in the 738, 40
as currently,
like today, or
okay.
yeah.
Which that would be a good number from how I've been reading things, but that's not my job.
We still have plenty of time to get to our actuarial return by June 30. So
we hope to get there. Yes. So are there any questions? Do we have any board member discussion on item 4F? Thank you, Robert. And are there any public comments on item 4F?
There is none.
Okay. That would bring us on to item 5.
Thank you,
which
Chair Land.
At this point, does Callan feel like they need to stay?
No, Callan's welcome to.
You're free to have lunch.
Thank you, Callan. Thank you.
You're free to listen.
Thank you all very much.
Yeah.
Thank you very much.
Thank you.
Thanks.
This item is a follow-up to several of the closed session discussions under labor negotiations that the board has had with me as the labor negotiator. Based on discussions with Human Resources and with Mr. Ravelis, we are bringing an item to the Board of Retirement asking for a motion for our board to recommend to the Board of Supervisors adoption of the Serial Section 31522.3, which would make Robert's position no longer subject to civil service but serve at the will of the Board of Retirement. I'm happy to answer any questions you may have. In a way, this aligns with our strategic plan and with our succession planning policy, because our policy does state that sort of Robert can step into my role in the event that the executive director is unexpectedly absent. In conjunction with this item going to the Board of Supervisors, Human Resources would be bringing forth a salary resolution. It also would provide minor edits to the job specs, which would be broadened to include supervision, potentially with the long-term goal of adding some accounting staff position that Robert's position would be responsible for evaluating. So if the board supports this, as we've discussed previously, we're looking for a motion that we bring this recommendation to the Board of Supervisors. Additionally, should this item be adopted by the Board of Supervisors, the other item asking for direction from the Board of Retirement today is a discussion about how much involvement and how you would like to pursue the evaluation of the Retirement Finance Investment Officer position. I've checked with a number of other serial systems, and Mostly, it seems like the retirement boards have maintained engagement in hiring and terminating, but they leave the annual evaluation to the executive director. But there are some options that would involve more board engagement in that annual process, and so there is a request to have direction regarding that duty, whether you want to delegate that duty as a board or retain it.
Okay, so I think we should first deal with the first part of this, which is the recommendation to the Board of Supervisors to adopt SERL Section 31522.3. And so we would be looking for a motion to adopt that, I believe.
So moved.
Second.
Okay, is there any public comment?
There is none.
Okay, so Judy, would you please do a roll call vote?
Mr. Kelly?
Yes.
Ms. Cavanis?
Yes.
Mr. Haschak?
Yes.
Mr. Swope?
Aye.
Ms. Cubison?
Aye.
Mr. Land?
Aye.
Approved.
Okay, that brings us to the second part, which is to offer opinions or guidance on whether the board has any appetite for performing performance evaluations for the RFIO on an annual basis. Does anybody have any comments as to that? And I do. Nobody has any comments?
Well-
We do have a comment. Yes.
I would just think that the executive director should do the evaluation, but should bring it to our board every time it happens, whether it's annually or by, you know.
I have a question. When you say bring it to our board, or do you mean for us to have a discussion or have a motion to approve, or?
Yeah, I think a discussion too, you know, we might add little pieces to it.
So Jeff, if I'm not mistaken,
That would be.
if I draft an evaluation, I bring it to the Board of Retirement, that would be a closed session discussion to get their input before it's provided to Robert, and then the evaluation itself, of course, is not public.
That's correct.
Right, and that's kind of what I was thinking, process.
And I would like a process to get any board feedback to incorporate it, and it could be part of that process of bringing the draft evaluation to the board.
Does anybody have any thoughts on the draft evaluation to the board guidance?
I will be using the county's standard format as it evolves, because I know they're working on revising that, but it would maintain the same standard form that the county currently uses in their evaluations for staff.
Okay, my instinct personally would be to completely put the impetus on the executive director to perform the evaluation. However, I think it's reasonable to expect us to be able to review it beforehand. That's a reasonable compromise, so to speak, although I would be concerned about what would happen if we had a significant difference of opinion and how that would be handled.
We'd talk it out.
We'd talk it out. And many of the items, that are on these performance evaluations, for those of you who have not had the recent pleasure of either providing them or getting them, many of them would not be stuff that we would be really privy to. And it wouldn't be part of our trustee, responsibilities to be aware of those.
Right. A lot of it is information that's gleaned from daily interactions and seeing the work products of the person, where the board as a whole sees Robert's position once a month and doesn't have the same level of contact.
Which is why I was leaning towards a process where we wouldn't really have that kind of involvement. We would be able to evaluate Robert every meeting at some point if we didn't like advice or participation in the meetings or something to that effect. That would be kind of exterior to the performance evaluation, I would think. Maybe not.
Well, and I think that's where the board feedback can be incorporated into the narrative as far as comments, areas to focus on in a coming year, praise
Sure.
or direction regarding past projects that the board would like to convey to the incumbent is where I would see that board's information coming out of that discussion when the evaluation is brought forward.
So I'm comfortable with incorporating Trustee Haschek's suggestion that we have that. If you're comfortable with it, I'm comfortable with getting on board with that. And if nobody objects to that, that can be our guidance to.
It
Do we have any
appears.
thoughts?
Do we want to clarify whether that's just advisory input, or is that something we would only deal with if we thought there was a conflict directly with what the director had prepared? I mean, I would think we would be okay with making it, for advisory purposes, or is there a need to clarify that, Jeff?
And I don't think there's a need to clarify. We're just looking for direction, and it sounds like, as the executive director said, you'll talk it out in closed session.
The only other question I have is when would the first performance evaluation be due?
It would be in April of next year.
Okay, so a year after the changes are made,
Yeah,
assuming that the changes were made to the position.
And the regular evaluation, he was on an April
Okay.
sort of review schedule anyway, and we would be looking at maintaining the schedule. With a change from HR that was going to trigger it as essentially 12 months from his last one, which was just submitted. So it's still going to be in that March-April timeframe.
Okay. And it sounds like we've exercised that. We can move on. Guidance is clear.
Yes, we have the motion, the guidance is clear, so that concludes this item.
All right. So that moves us to item number 6, administrative report. Doris Rentschler, Executive Director.
Thank you, Chair Land. Just a couple of items here. We will be scheduling opportunity to have trustee photos taken, so if you would like an updated one or you don't have one, you can contact our office to schedule a time. Also, if you would like to take this opportunity to update your board bio that we post on our website, we have a little brief background information on each trustee that's posted on the website. Some of those haven't been updated in quite some time, or perhaps not submitted at all. So we'd like you to take that opportunity to update your bio. I was asked by a trustee to find out if the board had any desire in holding like a full day offsite meeting. It would probably be mostly educational in as far as the agenda, and also a review and update of some of the strategic plan objectives. Last time we had our offsite at Yokayo Ranch, just outside of town here, but we would want to know if there's any interest in pursuing such a meeting, and if so, preference for like what time of year that it might occur, and location, so we can build that into the budget bring forth for next fiscal year.
Is this a Brown Act thing?
It is still a Brown Act meeting. It is open to the public. We did not have anyone attend in person when we went to Yokayo Ranch. I understand several years back they actually went over to the coast. And since we do record and broadcast, although I'm not sure we'd be able to broadcast from a remote location, we would still record it and it would be available on demand for people to watch. Would we have a Zoom meeting?
We would only be able to record the meeting if we did it via Zoom.
Oh.
We don't have staff from IS that can take equipment over and record and broadcast. I mean, I don't know that, I think the equipment is kind of prohibitive.
Did we do anything via Zoom last time? Because we had remote
We
speak?
did.
Okay,
We
maybe
did.
that's what I'm
Yeah. So
thinking
we
of.
just need to have good Wi-Fi.
We could record and not broadcast. I imagine even without Scott, he could train me. We could do that. That would be a possibility.
You certainly can via Zoom, yes.
Or, yeah.
Yes, sir.
I note a real advantage of Zoom now is that 2 minutes after your meeting is over, you get a AI created summary of the meeting. Boom. Better than any minutes that I've ever seen, and has all the salient points. Every once in a while, there's a little tweak. You might just spell somebody's name wrong. But that's the magic of now Zoom.
And we haven't used that Zoom function, but
it's free.
Yeah.
So,
and most amazing.
I guess, the mechanics of the meeting notwithstanding, you want to know whether or not there's an appetite by the board to actually have an offsite meeting. It would probably require a day.
We don't necessarily have to choose the specific date right now.
Just in theory.
But in general, like, are you more interested in a particular time of year? Then we can start narrowing down maybe venues and bring back a couple of options for the board as far as date and location. But any expression of preferences would be greatly appreciated, in addition to whether or not to have an offsite meeting, what time of year, location preferences, and even topics for a discussion would be greatly appreciated, and you're welcome to email me those.
I think in the past, they've been in the fall.
Yes, most of them have been in the fall. We did one in February when we were putting together our last board strategic plan. And that was with, of course, our consultant, Mosaic Governance Advisors. That strategic plan runs, I think, fiscal years 23 through 27. We've made a lot of progress on some of those initiatives, so it would also be a little update as to the strategic plan and maybe looking at other objectives to add to specific goals that were already adopted as part of that plan.
Okay. Yes.
Well, I just think it's needed and it's important, and so, I'll send you my little details.
Thank you. I appreciate any topics you want to put forward. Go ahead and email them to me. So yes, the last time our board did an offsite was February of 22.
Okay. It sounds like people will email you with suggestions, ideas, and I don't hear anybody speaking up against the concept. So we'll move forward with that being a potential budgetary item for next year.
Great, thank you. Additionally, we have a policy regarding a board performance evaluation where the board evaluates their own performance. The policy was actually developed as part of our strategic plan, and it specifies that the board would do this evaluation annually or as directed by the board. Since adopted, the board has completed the evaluation process once. I would like to know whether the board wants to complete a board performance evaluation in fiscal year 25-26. And if so, does the board want to engage a governance consultant to assist with the development and administration of the performance evaluation? As outlined in the policy, it can be done internally, or we can hire a consultant to assist with it. So I'm looking for direction there on whether or not the board wants to do an evaluation, and if so, how you'd like to proceed.
Anybody have any thoughts, comments on a self-evaluation? 360 evaluation, I believe, is what we're calling it these days. Yes.
I do think it's helpful to do that. And I don't know that we need to hire someone from the outside to help us. That's
Since this is my second meeting, I think it could be helpful, but I don't want to hire someone to come in at this point.
I think you're doing a fantastic job in your second meeting. I have no, there's no reason to oppose a performance evaluation of this nature that I can think of, so I think we should do it. Would this be like a closed session thing, or would it be a survey? I'm just trying to imagine the mechanics of this.
Last time it was done, we did not use an outside consultant. I did put forth a selection of like topics and some sample questions that I got some feedback from trustees that I put together the survey instrument. We then surveyed all of the trustees. My feedback from that process was they didn't like all of the involvement, asking them what topics they felt should be evaluated by the board, because in a part, you're judging your ability to work together and the outcome of that, as well as your own performance as a trustee. So I can certainly select questions on my own without board input, but it may not necessarily catch issues that maybe the board would want to have raised and evaluated, because I wouldn't be having anybody else's input. You could create a committee. I could follow the same process as last time, which is send out some samples and saying which of these questions would you like to incorporate, and then I kind of just compiled those answers and then put together a short list that covered a couple of questions in like 5 different topic areas. But I'm certainly open to suggestions on however the board would like to proceed.
Anybody have any suggestions? Catherine? Trustee
I'll just
Chavez.
make one comment here. I'm just kind of flipping through the policy now. It says that this is what is in your policy. The scope of the evaluation process and any resulting actions should be strictly limited to the operations and decision-making practices of the board itself. Issues pertaining to operations of MCERA or to management and staff will fall within the scope of other appropriate board policies, such as the executive director performance policy.
Yes, Trustee Cavness.
I just, I think that a question for you, like, if we included the amount of other external or internal education, would that fall within the realm of, like attending an ethics training, for example? We have a certain number of points every 2 years that we have to meet, right? For
educational
board.
credit.
Are you asking if the performance evaluation counts towards your continuing education requirement?
No,
Okay.
just that would be part of our evaluation.
Last time it did include a board's educational needs assessment to try to find out what topics trustees were interested in receiving more education on. And yes, I would intend to include that with any survey that goes out, so I can kind of do double duty. We don't have to address that separately. We'd address it as part of the performance evaluation of the board.
Thank you.
That also gives the board an opportunity to indicate what trainings they found most beneficial, but also just to specify topics for future ones.
Okay, I don't know exactly what we're,
I believe the direction was there was no noticeable objection to completing a board performance evaluation during the fiscal year 25-26, and that there is no interest in hiring an outside consultant to facilitate such, so I'll proceed with that. It would likely come back as far as the results in the fall, in the October-November timeframe as far as the completed work, although that timeframe can be adjusted according to the policy by choice of the board.
Results of the survey, does that become public record?
Yes, it does. Now, we might be able to time it so we could include this as a discussion item on the offsite to have more discussion about the specific topics of the board's engagement and how they work together. But, you know, right now I don't have an agenda for a potential offsite. I might bring forward some suggested topics and an agenda later in the year for board approval.
Okay. I think that's not the end of item 6.
So I appreciate the direction on that. The last item was just an update to let you know that we did issue an RFP for agreed upon procedures engagement. That's essentially having an auditor come in and evaluate our procedures and processes. We've selected 4 through the work of the audit committee that will happen over the next 2 fiscal years. So we will be working with the audit committee, whose next meeting is on April 9th, to select an auditor and bring that to the full board for approval of a contract. And so I just wanted to give you an update on that. And that is everything on the administrative report.
Okay. Thank you for that. That moves us to item 7, general board discussion. I did have a 50-slide and 2-hour presentation about our recent trip to Calipers. I'm sure everyone wants to hear that now. Okay, maybe not. Anyway,
I do have something, but you go ahead. No, you go ahead.
Okay. I had several items here. One is that I don't actually have a presentation about Calipers, but it was a great meeting. I'm glad everyone was able to go. It was had a lot of fun there and learned a lot of things.
And you'd recommend it?
I would recommend it. Yeah. I don't know that I'd recommend it twice a year. I don't know if I can work that out.
The General Assembly, the Calipers General Assembly only happens once a year.
So I definitely can't recommend it twice a year. I wanted to make a quick comment about the at-will nature. If that is, and this is where the Venn diagram of this job interacts with my other one, if that is adopted, I would like to know right away, because I'll have the privilege of backing out all the changes I made to accommodate Robert over the last year or so.
Yes, because of the special considerations under the current labor group. So it will go to the Board of Supervisors at the April 8th meeting, I believe is when it's scheduled. It is a consent item. I will let you know as soon as it is addressed at the Board of Supervisor level.
All right, it'll be ready to commit by then, the changes. And I'll bet you this is what Judy was going to say. Don't forget your Form 700s.
Gotcha.
Mine's almost done.
Okay.
I almost brought it with me.
I've received very few, and I know some of you have to submit it for other purposes to the clerk recorder's office, but I still need to receive a copy here. Yeah.
We can't just use one and Xerox it.
Yeah.
Yeah, you can.
Oh.
Yeah, absolutely.
Ditto won't work.
Ditto, yeah.
They don't share it with us.
Okay.
I mean, I could get resourceful and
Make a public
ask
record.
them to send it to us. Yes.
I actually have to do more for this than I do for that, so doing it once, well, be fine. So.
Regarding that, it's just outrageous that one cannot just attach a summary statement of your investments. You actually have to redo it and list them all. And
Right.
I disagree with that.
Fortunately, unfortunately, none of my investments qualify to be disclosed. So. Good or bad?
And then if I may, I had a question about the conference. Do we self-report our educational hours, or is that done?
They do not report it to us. So if you go on to our website where we have the educational reporting tool, you can then sort of just go through the agenda, list the topics that you attended, and report your own number of hours.
Thank you.
I don't need a very long, detailed description. Very general is good, but I do need to know your hours for sure.
Very good. Sure.
Is there any other board member discussion?
I would just like to thank staff and council for helping orient me in time to attend the meeting today.
You're quite welcome.
I'd just like to say I appreciated going to the CalPERS conference. I learned a lot. It was a lot of information, but it was very stimulating. So, good conference.
Outstanding. I guess that will conclude item number 7, and that brings us to item 8, adjournment and notice of next Board of Retirement meeting. The next Board of Retirement meeting will be held at the Mendocino County Employees Retirement Association Boardroom, 625B Kings Court in Ukiah, California, on Wednesday, April 18th, 2025 at 8:30 a.m. Thank you very much. That's a wrap.
I'll try this one more.